Well, let's get started. My name is Jared Farmer. I'm the chair of the National Grain Car Council this year and last year, as some of you might recall. Just want to welcome everyone to the 2021 National Grain Car Council meeting, the second, and I'm going to go out on a limb here and say final virtual National Grain Car Council meeting that we're going to have. Maybe I'll knock on some wood here in the room. Before we get started, I just want to thank the Surface Transportation Board for once again hosting the meeting today. It is, I think we have a really educational and informative program for everyone today, and I think it'll be very engaging and looking forward to lots of participation from everyone. I want to just thank a couple of people as we get started here. I want to thank Robert Primus, who's our STB vice chair of the council this year, and really rolled up his sleeves this year and helped us pull this program together. So really appreciate it, Robert. I want to thank Vice Chair Shane Barrett, who helped pull the shipper panel together this year. Really well done. I think we're going to have a great shipper panel once again. And of course, Mark Houston, who's our second vice chair for his council, and he always keeps us on track and answers all the questions we have. So Mark, really appreciate your help getting this organized again this year. And last but definitely not least, I want to thank Mike Small, who is our designated federal officer on the council. And he's been critical to our success both last year and this year with the National Grain Car Council meeting. And Mike is moving on to other things, and so he will not be with the Grain Car Council meeting next year. And Mike, I wish you the best in your future endeavors, and it's been a pleasure working with you the last couple of years on this meeting. So. And Mike will be replaced by Alan Cassidy, and on the next year's council board. So with that, I'm going to toss it over to Terry McDermott, the TEGMA chairman, to welcome everyone to the meeting as well. As we all know, National Grain Car Council is held in conjunction with TEGMA every year. It's been a very successful partnership for many years. Terry has 27 years of international experience in agricultural trade, logistics, and several transportation modes. Terry is currently the director of rail supply chain at Bunge, but also has worked for Ferromex as an AVP in agricultural products, and also the chief marketing officer with Ferromex. And I'll keep it short, Terry, and just turn it over to you to welcome everyone to the meeting.
Thanks, Jared. I appreciate it. Good afternoon, everybody from Kansas City. As Jared mentioned, my name is Terry McDermott, and in addition to working for Bunge, I am currently the chair of TEGMA. Looking forward to this joint virtual session with National Grain Car Council and the synergies that will come out of it. So I think this is the 12th year that the two organizations have had the joint fall session, and I believe that you will find this session, as the previous ones, as very enlightening as well. So just real quickly, briefly about TEGMA. TEGMA is a North American trade association whose members include grain shippers, receivers, as well as many related businesses, including transportation companies, ports, inspection agencies, etc. At TEGMA, we seek to provide a forum where grain-based agribusiness industry can debate, discuss, and facilitate resolution of operational and business issues, bringing insight to both its membership and stakeholders. We have a really good lineup tomorrow. Tomorrow's lineup includes Pat Ottensmeyer, the CEO of the KCS, as well as James Cairns, Senior Vice President, Canadian National Railway. Then we're going to follow that up with a 3-person panel on sustainable energy and transportation. That panel features John Campbell from Ocean Park, Michael McAdams from the Advanced Biofuels Association, as well as Tammy Klein from Transport Energy Strategies. And then we'll cap off the afternoon with John Brooks, who is the Executive Vice President and Chief Marketing Officer of the Canadian Pacific Railway. So we're looking forward to that. Again, just to let you know that the meeting does begin at 8 a.m. I welcome all of you to join us. And perhaps more importantly, or equally as important, there is a joint reception this evening, hosted both by the National Grain Car Council and TAGMA at 5:30 p.m. So for those of you that are in Kansas City, we will be in the City Beautiful C Ballroom at 5:30, and we hope to see everybody there. So with that, I will kick it back to Jared. Thanks, Jared.
I think I'm back. Thanks, Terry. Appreciate that. Glad to reminded everyone about the reception as well. That'll be fun. So now I want to turn it over to Robert Primus from the Surface Transportation Board to welcome everyone to the meeting. Mr. Primus was sworn in as a member of Surface Transportation Board on January 7th, 2021, following his confirmation by the U.S. Senate on September 16th, 2020. Mr. Primus was subsequently named, as I talked about, as vice chairman of the board, or was named vice chairman of the board on February 1st, 2021. And he joined our National Grain Car Council board this year to help us plan the meeting. And Robert, I won't go through your extensive resume here on the bio that I have, but I'll just maybe turn it over to you to welcome the meeting attendees.
Thanks, Jared. It's not that extensive, I know. I know you're trying to pull your time to trying to make it sound that way, and I appreciate that. And I appreciate everyone for being here. I just want to echo what Jared and Terry said earlier in welcoming everyone, council members, panelists, as well as attendees to this year's Grain Car Council meeting. As Jared said, I'm one of the newest members of the board, and I'm honored to be a part of the council this year and to be here. And I know that all of you, like myself, would have liked to have been in Kansas City, even though it's about 107 degrees heat index there. But I think we have a very strong virtual program, and I am very excited to hear the panelists that we have. I think we've got a great lineup, and I'm actually going to segue into, I know you guys didn't come to hear me, so I'm going to segue into the panelists and into the discussion. And so the title of our first is Economic Recovery Amid Disruption and Uncertainty. And we are very honored and really fortunate, honestly, to have Nate Kaufman present with us. Nate is the Vice President and Omaha Branch Executive with the Federal Reserve Bank of Kansas City. In this role, he serves as the bank's regional economist and representative in the state of Nebraska, recruits and works closely with the branch's board of directors, and is responsible for briefing the Kansas City Fed's president, a member of the Federal Open Market Committee, on economic and business activity in the state. In addition, Nate leads several bank and Federal Reserve System efforts to track agricultural and rural economies. Nate joined the Federal Reserve in May of 2012 and served as an economist in the Regional Affairs Department at the Omaha branch prior to being named branch executive. He received his PhD in economics from Iowa State University. So without further ado, I'd like to introduce Nate Kaufman.
Well, Robert, thank you for the introduction and the invitation to join you this afternoon, and welcome to everyone else. Robert, like you, I'll agree that it'd be far preferable to be in person. We're all accustomed, though, to doing the virtual meeting, so glad to be able to participate in this virtual meeting this afternoon. Before I get started a little bit in the presentation, I'll offer just a little bit about who we are at the Kansas City Fed and why we do what we do for those that may not be familiar. As most of you likely know, the Federal Reserve is the central bank for the United States. And the way that we are designed as a system is to have 12 regional reserve banks scattered throughout the country. And those reserve banks, along with the Board of Governors in Washington, D.C., comprise the central bank. Our headquarter office then is Kansas City. We've got branches in Omaha, Denver, and Oklahoma City. We cover 7 states in the middle of the country. So reflecting on that introduction, with the focus of our region in the central part of the country, we do have a large concentration in the commodity space specifically. So we do focus a fair amount of our attention on energy and agriculture, but also obviously track some of the general conditions that I'll talk about this afternoon. So pleased to be able to join you. I've titled my presentation for this afternoon and definitely hope to be able to have some time at the end for questions if there are some, but I've titled the presentation An Economic Recovery Amid Disruption and Uncertainty. And one way that I would characterize the recovery so far is that it has been quite uneven. And for those of you that are following this week's headlines and news stories may know that we're hosting our annual Jackson Hole Monetary Policy Symposium this week. That was also scheduled to be in person, but will be held virtually. I encourage you to tune in tomorrow at 9 a.m. Central to hear Chair Powell talk. The title of that program is actually Macroeconomic Policy in an Uneven Economy. And it's really just a way to characterize the nature of the economic recovery over the past year and a half. So if we want to move to the next slide, I'll offer just a couple quick thoughts before moving into some of the things I'd like to share this afternoon. So the first that I'd like to recognize is simply a snapshot of where we are today relative to where we had been a year ago or more now. And that is to say that it does appear that US and global economic activity has rebounded, in some cases fairly substantially, in other places it's been, like I said, much more uneven. This recovery which has been uneven, it's occurred amid significant disruption and uncertainty, which I'm sure that many of you are quite familiar, especially with those of you that do focus on aspects pertaining to the supply chain. The pandemic, as it has been for the past year and a half, along with some key items that we do hear from a number of our business contacts related to labor shortages, supply chain disruptions, and inflationary pressures will all continue to shape the outlook going forward. And I'll try to offer a bit of thought on each of those, especially as it pertains to some of the questions about inflation that we've heard a lot about in the past couple of months. Next slide, please. So just for a little bit of context before getting into some of the more recent data that I want to review, it's worth highlighting that before this pandemic, the US was in the midst, of its longest economic expansion on record. There's a number of different ways that I could show data that relate to this long expansion, but we often at the Fed focus on some high-level measures that people are likely most familiar with. One of those being economic output or real GDP, and another being just headline measures of unemployment rates. You can see, for example, in the chart on the left, which goes back to 1980 as a measure of GDP, the gray shaded areas are recessions, that from 2009, 2010 to 2020, the first part of 2020, we were in the midst of a 10-year expansion. And as you go back in time, if I were to have extended this chart back into history, you would see that this was the longest expansion on record, albeit at a relatively modest pace, but in duration still the longest nonetheless. Likewise, as we look at the unemployment rate, we had often been talking about the previous financial crisis and recession in 08-09, when unemployment rates spiked to about 10% in the months that followed. And we had been down to around 3.5% by the end of 2019. So these charts, of course, do not go past 2019, just as a way to indicate where we had been in the US prior to the pandemic. Next slide, please. So as we move forward then, and not belaboring the point about where we had been prior to 2020, after dropping sharply in the early months of the pandemic, we have seen economic activity recover substantially. What you're looking at in this chart is, again, a measure of GDP growth, but for a number of the major economies globally, as a way to give a high-level description of what's been happening, not just in the US, but in other places. And I'll try to describe some of the nuances of this chart here as well. The dark blue bars that you see on the left side of each region simply reflect the average rate of growth prior to the pandemic. So for the 5 years in advance of the pandemic, most major economies were growing at a pace that had been roughly similar to where they had been in previous years. And generally speaking, those forecasts were expected to be pretty similar going forward. Of course, we know that that was not the case. And what we saw in 2020 was a sharp contraction in GDP growth, as shown in initial estimates by the light blue bars. And I've shown the light blue bar as the forecast that was made in April of 2020 as a separate bar from what we actually observed in 2020, shown with the green bars. And the reason I've separated those is because in April of 2020, conditions were extremely dire in many different markets. And in fact, agriculture was one of those where conditions were extremely challenging. It turned out that activity was actually a bit better than what was expected by the end of the year. So in most of these regions, what you'll see is that the green bar is a little bit better than the light blue bar. As we've come out of some aspects of the pandemic, certainly with lots of uncertainty still remaining, the forecast for 2021 is actually a very substantial rebound in economic activity. And so this is owing to some of the comments earlier on supply chain challenges and inflationary pressures, recognizing that we've seen a very significant recovery. This recovery is expected to continue, generally speaking, but obviously subject to uncertainty, though fading a bit as we move forward, for example, in 2022. Next slide, please. So I mentioned that labor markets had been declining in advance of the pandemic. Obviously, unemployment spiked in the initial months of the pandemic, and employment levels have been recovering thereafter. The chart on the left-hand side is a snapshot of employment in levels for the entire country, going back to January of 2020 as a benchmark. And you can see here that there was a sharp decline by more than 20 million jobs in the initial months of the pandemic. There was a subsequent fairly rapid recovery in employment, then followed by somewhat of a plateau, but ultimately recovering closer to where we had been prior to the pandemic. As of the latest data, though, you can see that we're still a bit over 5 million jobs less than where we had been prior to the pandemic. It's worth pointing out again to the fact that this has been an uneven recovery, that some industries have been positioned much better than others. So obviously those industries that require a certain amount of in-person gathering have been hit hardest. So that obviously connects to things like tourism and restaurants, hotels. Many of the categories that you see described in the leisure and hospitality sector in the chart on the right-hand side, at its worst in April of last year, that industry had shed about 50% of its jobs before ultimately recovering to where we see it now at being about 10% less than where it had been. There are some categories that are very close to, if not right at, the level of employment that they had been before the pandemic, but still seeing that by and large, we're a bit less than where we had been before. Next slide, please. Another way to think about the recovery is recognizing how households have been positioned. And there's a number of different ways that we might measure this. We often reflect on the confidence of consumers, how households are thinking about their level of optimism with respect to the economy, which ultimately translates into spending. And consumer spending is, of course, one of the major drivers for the US economy. You can see in the chart on the left as a measure of consumer sentiment index that this measure had dropped, as many others had, sharply in March and April of last year, but then began recovering thereafter and was on a pace through the first half of 2021 to continue to recover. Now, what I will point out in this chart is the one data point that you see for August of 2021 that is much lower than where we had been. And so this is something that we're watching carefully. There's some questions about the sustainability of the recovery that we've been following so far. A lot of debate about this, obviously ongoing, but it's worth pointing out that that was a fairly substantial decline in consumer sentiment. Nevertheless, we've seen various categories of activity contributing to GDP growth for the first couple of quarters of 2021, but the composition of that activity has shifted. So as you all might be aware, going back to the end of 2020 and into early 2021, as there were various restrictions that were placed on movement in the economy that varied by region to a certain extent, much of the economic activity that we had been seeing at that time was driven by what we would call durables. And so this is largely goods and the movement of products as people were at home, as employees were working from home. A large amount of spending was being directed towards what we describe as durables, as opposed to non-durables or obviously services. It's worth highlighting here that services is the biggest part and biggest driver of our economy. So one of the sources of optimism more recently has been that there was a shift from the contribution of durables to GDP growth in the first quarter into the second quarter, where we saw services being a larger contributor. So this is simply reflecting the optimism from things like vaccination and maybe fewer restrictions to move about the economy as there had been prior. Next slide, please. Some other indicators that I would highlight to show some of the pace of recovery is recognizing the impact of global economic activity and trade specifically. Trade both to and from the US has strengthened notably despite changes in the value of the dollar, which at times have also been quite significant. The chart on the left shows a couple of categories. I mentioned earlier that we focus a large amount of our attention on energy products in addition to food and agriculture. The blue line in the chart on the left simply shows an aggregate measure of exports as a way to highlight the fact that we actually are higher than where we had been in the months prior to the pandemic, seeing a significant rebound in export activity. And in addition to that, seeing significant increases in both food and ag products as well as energy. There's some seasonality, of course, in agricultural shipments that is at play here, but going back to about July and August of last year, we started to see large orders being placed, particularly by China, for exports. And so that has generally continued in more recent months as well. Imports have also continued to rise quite rapidly. And so, again, many of you are, I'm sure, more familiar than I am with some of the supply chain challenges and backups at ports and delays with shipping. And many of those things are comments that we also hear from our business contacts alongside significant increases in imports. This trading activity, though, has increased despite, again, the fluctuations in the value of the dollar, which we know are important in terms of the kinds of incentives that they create for foreign buyers of US products. Going back to March and April, we saw a significant increase in the value of the dollar, shown by the black line. That often happens when we have large events connected to uncertainty, where there tends to be a gravitation to stable currencies such as the dollar. We started to see that soften a bit toward the end of 2020 before picking back up again here in the first few months of 2021. Next slide, please. So household investment has been relatively strong. Spending has been strong. We've seen households willing to spend not just on products, but also services. Trade has been relatively strong, but so too has business investment. And again, there's a number of data points and indicators that I could potentially show. This business investment has been strong despite what I would describe as supply chain disruptions. And what we hear a lot about from a number of our contacts, especially in the manufacturing space, is disruptions in the supply chain and ultimately costs associated with the transportation of those products. So a headline measure that we often refer to give a sense of activity in the manufacturing sector is the ISM index, and this is shown in the chart on the left. The headline measure has most recently been right around 60. So anything above 50 essentially means stronger than it had been, whereas less than 50 would be weaker. You can see that in most cases here, the indicators are actually quite positive. I would say importantly, new orders have also been extremely strong. And so this is generally a pretty good indicator for forward-looking activity. Many of our contacts, both in our region and nationally, are also reporting backlogs on orders that are quite a bit larger than they had been even before the pandemic, but even in most recent months as well. And also recognizing that some of these disruptions have created some challenges in terms of maintaining inventories at the level that they would otherwise want to be. The chart on the right then is just simply a recognition of what we hear a lot about from our contacts as it relates to the cost of transportation. And there's a number of different data points that I could potentially show. This is simply a measure of prices connected to the movement of containers. So a world container index, seeing that this has really increased by about 5-fold relative to the pre-pandemic months and has continued to accelerate through the first half of 2021. Next slide, please. So we hear a lot from our business contacts about supply chain disruptions and, again, delays and challenges in managing those supply chains. But probably even more common than that comment is connected to labor shortages. For about 5 years before the pandemic, I would say this was the most common comment that we would hear from our business contacts, was that they were having challenges filling positions. It started with certain specialty and skilled positions, but before the pandemic, by early 2020, it really was a more general comment that we were hearing from a range of businesses, not in any one industry in particular. There was a belief then that with the pandemic, as we saw a massive increase in unemployment, that there would be much more labor available as people would be looking for jobs and the challenges of the pandemic. You can see, for example, in this chart, which is showing simply a measure of worker availability, this is simply taking the number of unemployed people in the population divided by the number of job openings that we have in any given month nationwide. So if the number here is less than 1, this simply says that there are actually fewer people unemployed than what we have job openings available. So again, you can see the spike there in early 2020 with the first few months of the pandemic as there was an increase in unemployment. But this measure has quickly returned to a number less than 1.0 again, which is reflecting a return to an environment of significant labor shortages. So again, many of our contacts are pointing out that it's challenging with supply chains, not just because of the large increase in demand globally, but also because of some of the challenges connected to having a sustainable and regular workforce. This also depends on industry and region, but again, is highlighted as something that we hear quite often from our contacts. Next slide, please. So one of the other things that we hear about and have been hearing about more recently from our contacts is related to inflation. And I say that we're hearing about this because for the better part of the last decade, this is not something that we heard a lot about. In fact, most contacts would have said that inflation really has not been an issue. If anything, price pressures had been muted for the better part of about 10 years. In June of this year, though, we saw a sharp increase in consumer prices of about 5.4%, as you'll see in the chart on the left. That was an increase in prices relative to the previous year. The Fed has a stated goal of inflation and managing inflation at 2%. And so you can see that as prices start to move above that point, it generates a lot of discussion about what might potentially be done to bring inflationary pressures under control. But of course, part of that debate is a debate about whether or not those price pressures are persistent or whether they might be transitory. And so this is something that if you are able to listen to the Jay Powell's comments tomorrow, I'm sure that he will touch on aspects related to inflation as one of these things, because this has been in the headlines quite a bit. The chart on the right is a way of recognizing that there's at least some support for thinking that some of these inflationary pressures could be transitory. I've chosen a few specific categories for a reason. These are some of the categories that were contributing significantly to inflationary pressures earlier in the year. The numbers that are shown in parentheses are simply the weights on inflation that each of these categories provides. So for example, if you had been trying to get a rental car at an airport or wherever it is that you're going in early 2021, it would have been very difficult. Used car inflation was running at about 12% in June. But what you can see here in the latest measure in July is that it was actually a bit lower. The same was true also with airfare, with other things like car insurance, as we think about energy prices and other aspects related to those markets. So there were a quite small number of product categories that were driving substantial inflationary pressures in June. And it's thought that perhaps some of these categories, as we start to even out in the economy, those price pressures will naturally start to reduce a little bit in terms of pressure. Now, it's worth noting here, though, when I say that they might reduce, what I mean is that the inflationary pressure might subside. It does not necessarily mean that prices themselves might decline. When we think about inflation at the Fed, we think about it as a rate of growth. And so what we're ultimately looking for is stability in terms of that rate of growth. It's not necessarily the case that these prices have to decline in order for inflationary pressures to be more under control. So worth distinguishing there. Next slide, please. So I've got just a few more slides that I want to wrap up with, and then I'm glad to take questions if there's some time. From our perspective at the Federal Reserve, of course, one of the main mission areas of the Fed is to conduct monetary policy that would be appropriate alongside the path of the economy. Historically, the standard way that the Fed would have done this was by managing the federal funds rate, which is ultimately a benchmark interest rate that informs the policies and pricing of lots of other financial institutions and is also a benchmark for other global things as well. This benchmark interest rate, as it had been in the past, was reduced to roughly zero in the early months of the pandemic, following some increases prior to that as a way to try to normalize monetary policy that had been in place since the last recession. One of the other tools, though, that has been used more aggressively in recent months is actually the tool that had been used coming out of the previous financial crisis and recession, often referred to as quantitative easing or a large-scale asset purchase program. This is simply the purchase of assets, specifically treasury securities and mortgage-backed securities, as a way to drive down longer-term interest rates. In advance of the 08-09 recession, the Fed's balance sheet had been running at a pace at about $700 to $800 billion. That had then ballooned to about $4.5 trillion in the years that followed the financial crisis. And you can see that it has increased to over $8 trillion now. I suspect that this will also be of significant debate in the program tomorrow, as there's questions about if and when the Fed may start scaling back on some of these asset purchases in recognition of some of the economic growth. Next slide, please. So despite all of what we might talk about from an economic perspective, at the end of the day, much of our outlook for the past couple of years now has been tied directly to the pandemic. I'm not going to belabor this slide. We're all familiar with what these charts show. It's simply a way to highlight the disruption associated with the pandemic, showing COVID cases on the left. Those cases and obviously the concerns that surround them are then to some extent mitigated by vaccinations and the pace of those vaccinations, but of course that ongoing debate as well. But this slide simply to recognize that this is continuing to be one of the major drivers of how we perceive the strength of the economy going forward, and with the variants also being part of that story. Next slide, please. I do want to end with one chart before providing a couple last remarks that are specific to agriculture, because this is something that we focus on a great deal at the Kansas City Fed. I know I'm looking forward to Ankush's comments next as our next speaker that relate to agriculture. And I want to offer just a couple comments on this quickly. Agriculture was in a spot from about 2010 to 2013 that many would have thought it was the best of times that anyone would ever experience in agriculture. We went from that environment to one that for about 6 years, from 2013 to 2019, was actually quite weak. And there were concerns about ag, different than the rest of the economy, being in a prolonged downturn. Now, however, and even though the outlook in April of 2020 was quite, as I mentioned earlier, dire, conditions in agriculture have rebounded substantially. And so there is a view by and large that at least for this year, people are generally pretty optimistic about conditions in ag. Now, I didn't describe this chart, and I will very briefly, as a way of saying that what you can see in these three different time periods is that when the US economy had been in a relatively weaker state, agriculture has been doing well. And then when the US economy had been doing better, for example, in the long expansion between 2013 and 2019, ag was in a more difficult spot with suppressed commodity prices. And now as we look at the most recent time frame, we're again seeing relatively limited growth in that time span at a time when, again, ag commodity prices have picked up along with prices of other things. And we're looking at actually substantial rebound in farm income relative to a couple of years ago. Next slide, please, and I'll end with some remarks here. So just to quickly wrap up, again, much of what we see in the way of business and policy decisions will be predicated to a significant extent on both the timing and the magnitude of stabilization. For the last 2 years, there's been lots of conversation about when this might be. And lots of businesses that we interact with have been delaying various decisions and wanting to see more certainty. which is again a recognition of the unevenness in the economy. There will be, I think, many questions that still remain about the persistence of structural changes. I won't go through all of these, but real estate is certainly one of those. How and where people work, what it means for the retail sector. Many other things I think will still be uncertain for some time to come once the pandemic ends. And again, lastly, as a comment on commodity markets, which is of significant focus for us at the Kansas City Fed, here too, this will depend crucially on the outlook for global economies and economic growth. There could be still some regional production disruptions. I didn't even mention the severity of the drought that we're in, for example, but lots of other things that will shape these prices. But at least for 2021, it looks like a number of our commodity markets in our region are looking a bit better than they have been. So I'll wrap up my comments there. I'm glad to take questions if there's time now, or delay if answer wherever is appropriate.
And Nate, I have one question so far. If anyone else wants to ask a question, please let me know in the chat. But first, we have a question from Greg Twist. Nate, you mentioned that the total US employment is down about 5.4 million from pre-pandemic, and that industries like restaurants were the hardest hit. Every restaurant I've gone to has a now hiring sign in the window. What is holding the 5.4 million people back from getting a job?
That's a fantastic question in a couple different ways, and I'll answer with a couple things specifically. There had been a lot of debate last year and even through the first half of this year about the effect of the unemployment insurance programs as being one potential source. Those unemployment insurance programs provided a flat supplemental enhancement to those that had been unemployed, regardless of what industry or what job they may have been in. Leisure and hospitality jobs, and specifically those in restaurants, do tend to be lower paying. So it's at least plausible that some of those unemployment insurance programs were contributing part of that, but I don't think that's the entire story. I think a bigger part of the story is actually the fact that in the early months of the pandemic, we saw a large contraction in the number of businesses in operation, large effects on small businesses. Even by the end of 2020, we still were at about 20% fewer small businesses, and that includes restaurants and a number of those that would be connected to restaurants, about 20% fewer businesses than what we were prior to the pandemic. So even as there may be restaurants opening, and as you're seeing hiring signs in the windows of some of these restaurants, I think it's partly a recognition that we simply have fewer businesses and fewer restaurants than what we had before. To a certain extent, I think that this is why we're seeing some of the disruptions more generally that we are in the economy, is that a number of businesses had faced significant pressure and really were not able to come back. So I think that that's at least part of the story, but I'm sure that there's lots of other complications with this. Some of it may also reflect, the fact that people may move on from one industry to another as there's been ongoing pressure in that industry as well. So those are a couple possibilities, but I'm sure there's maybe some others that are part of the story.
Thank you, Nate. Another question from Mark Houston. Are you concerned about inflation staying high, and for how long?
So inflation is one of the core mandates of the Federal Reserve. So we often refer to our dual mandate, which is to foster maximum employment growth on one side of the mandate, while in the context of price stability on the other side. And so again, the goal, the target for the Fed is a 2% rate of inflation. And so for the most part, that's over the long term. So the goal is to have inflation running at that level. There's a recognition, though, that in any given month, this might not necessarily always be the case. It might be for whatever reason that there are some disruptions that cause inflation to run a bit higher than 2%. And there might be some times where it's actually running a bit lower than 2%. The question about inflationary pressure and are we concerned? Obviously, yes, we're tracking that quite closely. And I would say that's probably in the top 3 of things that we're following on a regular basis and asking on a regular basis of everyone that we interact with. When a measure like inflation hits 5% and our goal is 2%, that does raise a lot of questions. But again, I think that it's worth re-emphasizing that many of these things that were driving that sharp increase in inflation are likely to come back down once the disruptions that we're experiencing do come back under control. So the question about how long, to some extent, is then predicated on the answer to that question of how long some of these disruptions might persist, which in turn is, of course, related to the pandemic. So it's difficult to put any kind of time horizon on that inflation. The Fed looks at, like I said, a long-term measure, and even that is probably not quantified specifically, but rather as a way of saying that over months and years, we would like to see inflation running at that level of 2%. If it were to persist for some months at the level that it's at now, and if that's running counter to what might have been expected, then I could see that generating a little bit more conversation about what, if anything, might need to be done.
Thank you, Nate. You may have just answered this somewhat, but I'm going to ask it anyway, just in case there's some nuance here that I'm not aware of. When considering action to control inflation, does the Fed look at month-to-month changes or year-to-year? And when would they change the parameters? And that's a question from Jerry Cope.
Yeah, good question on that. And what data do we look at? And the best way that I can answer that question is yes. We look at all kinds of data. We look at month over month and year over year. We zoom out and look at longer term trends. Things like demographics matter a lot. Productivity matters a lot. And so we think about those in the long-term context. We also think about expectations a lot. And this is actually where it's particularly useful for us to interact with businesses that are on the front lines of making those decisions. If we're interacting with businesses and they're telling us, we're thinking about putting off some of our capital spending plans and we're not making the hiring decisions that we thought we were going to make a few months ago, that gives us a little bit more of a glimpse into how we might see conditions play out again in the future. And so those are things that we look at on a regular basis. Again, the structure of the system is to make sure that we're incorporating not just national numbers, but also regional views. So our goal at the Kansas City Fed is to make sure that we're representing our region and the businesses and households within our region as part of that as well. So there's a large number of data points that go into monitoring some of these conditions and trying to be as responsive as we can to new developments.
All right, thank you, Nate. Now a question from Robert Primus. To what do you attribute the strength in the current commodity market, and do you see it lasting beyond 2021 to 2022?
So I'll answer first with respect to agriculture as it relates to commodities as something a bit separate from energy. Although what I would say is that even those are two very different markets, I would say that the forces that are underlying both of them are actually quite similar. And what I mean by that is that in both cases, there appears to be relatively robust demand growth alongside some challenges in expanding supply. So in the case of agriculture, for example, as you see economic activity pick up a bit, as you see export demand, again, specifically China, showing a lot of strength, that represents some significant increases in demand growth. At the same time, though, as it relates to agriculture, we've been, for the past couple of years, 2 out of 3 years anyway, looking at some relatively major supply disruptions, whether it's flooding or this year, whether it's severe drought, not just in the Western United States, but Brazil and parts of the Black Sea region, Ukraine, Russia, also looking at some significant drought. And that's been weighing on production. So the combination of robust and relatively prolonged demand growth the past 9 to 12 months in agriculture alongside challenges increasing the supply of those products has really been the primary driver of the increase in prices. I won't offer too many comments on energy other than to say that it's largely the same forces. So the rebound in economic activity connected to more movement in the economy has generated more demand for various energy commodities at a time where some of the increase in supply has been a bit more constrained, whether that's by way of discussions with an OPEC or whether that's other constraints that might be facing producers in the United States, recognizing cost pressures and other things to really expand production. So we really haven't seen rig counts, for example, pick back up to the same level that we've seen the increase in prices, suggesting that there's maybe a bit of uncertainty weighing on that market as well. So I don't necessarily have a forecast for the duration of the level of prices, I do tend to be in the camp that I don't think the level of prices, at least in agriculture, is sustainable. I think at some point we will have production that addresses some of those demand and supply gaps. But at least for the rest of 2021, that doesn't appear to be the case, and prices are likely to remain strong for the coming months.
All right, thank you very much, Nate. I think those are all the questions we have for you.
Great. Well, thanks, Mike. I appreciate the opportunity to speak this afternoon. Again, would love the opportunity to meet all of you in person, but appreciate the invitation and a chance to join you virtually.
Of course, it's been great having you. Next, I will turn it over to Shane Barrett to introduce our next speaker.
All right, good afternoon. My name is Shane Barrett. I'm currently Director of Transportation for the Gavilon Group, and I serve as Vice Chair for the National Grain Car Council. It's my pleasure to introduce Ankush Bhandari. Ankush is currently Vice President of Economic Research at the Gavilon Group, a leading agricultural commodities management firm located in Omaha. He's responsible for the company's grain, oilseed, biofuel industry research and analysis. Ankush has been a keynote speaker and presenter at various conferences in the United States, Europe, Southeast Asia, Mexico, and South America. He's also delivered market outlook presentations at various industry associations and roundtables. He earned his MBA in finance from Emory University in Atlanta. Welcome, Ankush, and thank you in advance.
Thank you, Shane. Good afternoon, everybody. Thank you very much for the opportunity and the invitation to speak at this event. I would like to thank the Surface Transportation Board as well as the National Grain Council for not only inviting, but also trying to keep this tradition going of the conference, even though it's in a hybrid model. Here's a quick disclaimer. Pretty much kind of says that most of the comments that I will make today are mostly mine and not necessarily that of Gavilon's. So obviously my presentation is going to be the changing landscape for agriculture, and dare we be optimistic. And here are some of the key issues for the year ahead, and I'm going to kind of talk to these in the slides ahead. Foremost is, what are the ongoing effects of COVID? And what does the post-vaccination world really hold, whether it's for driving demand or it's for meat demand or the reopening of restaurants? What are the current harvest numbers for South America? And more importantly, what is there going to be the response for not only planting, but also production in the coming years? For US, the US growing season is mostly behind us, but there's still a lot of uncertainty on what these yields and production will be, and we'll try to find that out in the next 30 to 45 days. Biofuels, so this is gasoline demand and its effects on ethanol, but also what does California want to do with its new mandate on the low carbon fuel standard? What will world trade be for corn, soybeans, and wheat? And most importantly, what will be the share of US for all of those commodities, and more importantly, the timing as well. The large spec, we know what the current fundamentals are. What does the large spec want to do along with the producer and end user? Where are they today? How many corn and soybeans do the Chinese want to buy? And you probably want to add wheat with it. The importance of the value of the dollar, and then the effect it has not only on acreage, but also on the selling along with the stockpiles that the various countries would keep. And last but not least, is there going to be an acreage battle next year? So the first and foremost, I know most of the folks have seen the number of cases along with the vaccinations. I completely understand that it is lives versus livelihood. Both of them are very, very important. If you start to look at it, that the focus now has been mostly on the pace of vaccinations and move away from cases to a certain degree and the pace of reopening of the economy. Again, we're holding this conference in virtual for a reason that I think there has been a spike in cases led by the Delta variant. Today, I think we have, at least in the US, about 170 million of us vaccinated out of the 280 million or so over the age of 12. So we're about 60%. I would surmise that by the end of this calendar year, we will be somewhere around 210 million out of the 280 that would be vaccinated. So we'll wait and see what that will be, but that would be our forecast today. So we know some of the grain ag fundamentals that are going on in the marketplace. The large spec is currently long corn. They're slightly long soybeans, and they've kind of exited most of their wheat positions. In fact, if anything, they are long the hard wheats given the drought situation, not only in the Western United States, but also in Canada. If you move over to the producer side of things, the producer has probably sold more corn and soybeans than last year. I wouldn't necessarily say more than average. On the other hand, you have the end users, whether they're in the US or in the rest of the world, they remain very hand to mouth. They really are not having a position more than 30 or 60 days. Maybe it's the higher price, there's the higher freight rates that we'll talk about, but they have been at bay. Last but not least, we have the index funds, who are the folks who kind of view the commodity space as an asset class or as a hard asset or a hedge against inflation. Those folks actually have the biggest position that they have had in the last 10 years, given the prospects for inflation. And you heard Nate talk about some of the inflation numbers and what holds in the future. But today it seems that the index fund community wants to participate in that story. So what are the prices for beans in US? And along with that, we'll also do the conversion for the Brazilians as well. We're looking at this in May soybeans, which is nothing but the November soybeans of South America. As you know, that when we plant, they harvest and vice versa. So today, those folks, especially down south, are looking at what they would be planting and that they will harvest sometime in late winter, early spring. And today, those prices are up 45% from where they are for this time of the year, just before they would start planting. We'll talk a little bit more about production, but today it seems like there will increase the production, the acreage in South America. Brazil, probably close to 5% and maybe about 3% more in Argentina. So they are responding with higher acres given the current prices. So in the US, here's a little bit more detail than you want, but I'll talk a little bit about national and then the state level. On a national basis, it seems we're going to look at supplies, which is nothing but this year's coming production along with last year's supplies or the ending stocks that we brought in. On a national basis, I think we'll have corn supplies down about 200 million bushels or so, about 1.5% down. For soybeans, we'll have it down about 3% or about 125 million bushels. So overall, you'll have somewhere around 350 million bushels less. If you look at the regional landscape, the states that are going to be lower are Minnesota, South Dakota, Nebraska, Missouri, Wisconsin. The ones that are going to be higher is Iowa. Again, they're coming back from the derecho last year. And then Indiana, Ohio, and in fact, even North Dakota, but keep in mind that might be more led with the higher acreage that they planted versus last year. Again, the regional and the state level supplies will be kind of key as we start to talk about the flows for not only the domestic markets, but also for the export flows in the balance of the crop year. So who will feed China? So I came to this country probably 25 plus years ago, and there was a book written by Lester Brown called Who Will Feed China? And we waited and waited many years. And finally, about 18 months ago, the Chinese started to really buy corn in a big way. Last year, they were probably, USDA has got them for about 26 million metric tons. It seems like we will probably end somewhere around 28 to 30 million metric tons. If we talk about this new crop, they've already bought about 11 million from the US, and probably some more from Black Sea as well. So it looks like they are on the path to remain as the largest importer of corn in the world, still wanting to buy 25 to 30 million metric tons, with a good chunk from the US. On the soybean side, it seems like they are recovering from not only the SF, but also wanting to probably comply with the phase one, which was signed close to a year and a half ago, that they would probably buy more than 100 million metric tons. The difference, though, we believe that they will buy less from the US this year than they did last year, to a tune of about 15%. And the reasons are twofold. One, the old crop supplies are very tight, which will kind of delay the start of the new crop program. And two, the South Americans have bigger supplies here on SEP 1 than last year. So if you look at the production for South America, that is, some of it's getting harvested now, some of it's going to get planted, so I'm going to break it apart a little bit. But let me first start with the 2021 crop that's being harvested in corn right now. They were mired with a lot of trouble. Delayed planting, and then drought, and now frost, that has kind of capped their crop to 87 million metric tons, which probably needs to come down a little bit more. The repercussion of that is, with their domestic demand increasing to led by not only their feed demand, but also the new ethanol corn-based industry, that this will not only restrict their exports, but also there will be times when they might be an importer of corn from Argentina. So the US might have a good window from mid-October probably until February, when the corn program probably will start to take a better shape. The soybeans are a different story. I told you a little bit about the higher prices, which will kind of bring in higher acres. And we will start to look at a record crop coming in January. So the US exporting window will be shortened very much in this crop year. And not only that, they also have bigger supplies. So the US window will be very, very short this year compared to what it was in the prior years for soybean exports. So I know Nate touched on this a little bit, but there has been a big snapback and a huge rebound and unprecedented recovery in retail sales. I would blame it on the 3 S's I call. One is obviously stimulus. 2 is the savings, or I would say forced savings. And 3, I would call the stock market. A combination of all of those led the consumer to start to buy goods at a very, very fast pace in the post-economic recovery after the COVID. It doesn't matter when you look at the total retail sales of the various categories, all those categories, there have been huge year-over-year jumps, from home improvement to car sales to building material. This has led to record imports, and you can see these imports up here. The graphic kind of shows the consumer goods imports have been at record levels or at a torrid pace. The supply chain, the port capacity, the railroads, and the truckers have all underbeen the wrath of not only making sure of moving the goods from the factories to stores, which would have been the case earlier, but moving this goods from the factories all the way to now what's called the last mile to your doorstep because of what had happened with COVID. This is just a couple of snapshots of things that are going on. I kind of clipped out a lot of the headlines, sources Bloomberg and a lot of other places, the Wall Street Journal and Reuters, with all the headlines that you've probably been seeing regarding shipping. A lot of folks calling it the shipping inflation. A rising tide definitely lifts all boats, no pun intended. The number of containers that are coming to the US to fuel the retail sales that I just showed you earlier has been unprecedented. That has put strain on the shipping community, which has led to record rates for not only intermodal, but also the bulk commodities. I do not have a crystal ball to tell you where these rates are going. We focus a lot more on the ags, but I think this would be a good discussion as we go forward for the next panel to kind of keep on these 2 topics regarding not only the pace of recovery, but also its effect on supply chains along with the higher rates of the shipping that has been there. World trade has been on a torrid pace as well. If you look at last year, the world trade increased by about 12 million metric tons. If you look at wheat, this is the one that's probably going to face the most difficult path of being higher year over year due to the tight supplies in the various exporting nations, along with what's happening with the US and Canada. Corn is going to increase by 4 million metric tons, mostly on the heels of ex-China wanting to make a recovery after last year. And then soybeans, not only the China recovery, but also the ex-China recovery will ask for bigger numbers. So today we think that the corn and the soybean trade has the best path to grow, while wheat will be constricted given the tight supplies that we have around the world in the exporting nations. So where does this bring to the new crop exporting supplies? Where are we today? We're about a week away from starting the new crop, which starts on September 1. If you look at new crop commitments today, they are near record levels, mostly all led by corn, led by China mostly. If you look at wheat, we're still awaiting more export program to come to the US, mostly for HRW in lieu of spring wheat. And then as I mentioned to you, this soy program is not going to be not only delayed, but it'll have a lot shorter window than in prior years. So for the first half, what are we expecting? So this is the seasonality of exports out of the US. We'll focus a little bit more on the first half since it's been from September to February. In the first half, we expect that the exports overall will be down for corn and beans, mostly led by the bean program pulling it down while having a higher number for corn. The South American supplies in corn are lower, helping with the US program, while these South Americans, once they harvest the new crop starting January, US will face some headwinds starting January if they have the big production. Again, at the end of the day, the final South American production numbers and the China buying patterns will finally dictate the flows. This is a new one, but I think the group really needs to know about the changes that are coming for renewable diesel. California has mandated a low carbon fuel standard, which asks for that the carbon intensity of the old school traditional fuels, which is diesel and gasoline, to be constricted. So for that, they need to start to use more alternative fuels, or for reasons, you can either start to use a lot more EVs or start to use renewable diesel replacing the traditional diesel. They will ask, and a lot of the energy companies have started to put a lot of money behind these projects. If you look at the graphic, we're going to go from 1 billion gallons of renewable diesel capacity all the way to almost 5.3 billion gallons by the end of 2024. Again, there are not enough feedstocks, so the market will have to figure this out sooner than later, how they're going to do this. There have also been announcements by other states, Washington and Oregon, that do want to follow this, along with other states in the pipeline wanting to follow on this path. Animal units, if you start to look at it, this is USDA's way of kind of looking at what's going on in the animal space. I won't get into detail of each species, but as we look at all the 4 species, 3 out of the 4 will be lower year over year. Cattle, hogs, and poultry, all 3 will be lower year over year, and that will lead to lower meat consumption. There has been a little bit of a snapback in food consumed back outside of the home than inside of the home, but this will lead to less use of feed in 21-22 than we did in 2021. Work from home, domestic gasoline demand. Our office is back to almost 100% capacity. But my wife, who works for a firm in New York City, she has not been to the office in about 18 months, all working from home. Commuter demand typically makes up about a third of total gasoline demand, and that has been a headwind. But we've seen people take a lot of vacations this summer, not only a catch up from last year, but also as they were not getting on a plane and wanted to go visit a lot of places. Gasoline demand has been running anywhere between 3 and 5% lower. And as we look forward for next year and the pace of vaccinations that we talked about, we probably see that ethanol demand in the coming new crop will be up about 2% or so. Major wheat exporter ending stocks, as we talked about, wheat is the one that's going to face the toughest path to a higher year-over-year climb for world trade. This is primarily led by having very tight supplies for wheat in most countries, to not only include Canada, but also Europe, along with having export restrictions in Russia. The US still has not seen business, but we await business sometime in the next few weeks, mostly for hard-red winter wheat in lieu of spring wheat. And we really await that over the next 30 to 60 days. Last but not least, let's talk about the ratio, the November beans to the December corn ratio. It's never too early to look at this ratio. Last year, we planted about 180 million acres of corn and soybeans. As we look forward to the 22-23 year and what we will plant in spring, there are a few things to take note of. First and foremost, we will see increased winter wheat acres given the high prices that are there this fall. 2, corn, soybeans, and spring wheat, all balance sheets are tight today and will all look forward to having higher acres. So that battle will still be there. One thing we didn't touch upon is the input costs are going to be a lot higher for the producer on the heels of not only higher fertilizer, but also to a degree on seed. And we're also starting to hear that on cash rents as well. So that will start to be talked about. The onus is also going to be on prevent plant to be no more than 1.5 million and 2. This year we had about 2 million acres, so we can start to have record number of corn and bean acres again in the US. So in summary and takeaways for me, we'll start to talk about COVID situation and vaccine. That's the biggest driver for the economy today. And when I say the biggest driver, it starts to affect not only the gasoline demand for ethanol, but also the reopenings affect the consumption of food. The large spec have most of their chips for being long corn. They've exited wheat given the looming situation, mostly in North America, led by spring wheat in US and Canada. The end users kind of remain hand to mouth, while the producer has done a good job of marketing his or her grain so far. Most of the US critical weather is behind us, but the size of the US crops are still not known. In the next 30 or 60 days, they will show so. We showed a map to kind of show you the discrepancy between the various state levels. Record South American corn crop being awaited. This is the crop that will get planted later on and will get harvested in spring and summer of 22. This will be really awaited by the importers, but in the meantime, the US could be privy of higher corn exports due to that. The Brazilian supplies for soybeans are a lot higher this fall than what they were last year. This will continue to be a headwind for US exports, along with US having smaller supplies than last year. World trade for corn, soy, and wheat will be a record, but I think it's going to be primarily led mostly by corn, then maybe by beans, and then I think wheat has a chance to just being flat on a year-over-year basis. And last but not least, I think there is definitely an acreage battle looming for spring 22 for spring wheat, corn, and beans. And in the meantime, winter wheat's going to poke its head up for higher acres on a year-over-year basis. So with that, thank you very much. If there are time for some questions, I'd love to take a few of them.
Thanks very much, Ankush. Let me see if there are any questions coming through the chat. Grain Cart Council members, let me know if you have any questions. All right, Ankush, I do not think that we have any questions. So thank you very much for your presentation.
Thank you, everybody. Thank you very much and appreciate the invite and the opportunity to speak at this event. Thank you, everybody.
All right, and next I will turn it back over to Shane Barrett, who will introduce the moderator for our shipper panel. Shane?
Okay. Thank you, Ankush and Nate. Again, two great presentations and very informative. So thank you. With that, we'll move forward to our shipper panel. Moderating the panel will be Sean Miners, Director of Logistics at the Andersons based in Overland Park. Sean's responsible for rail logistics for various business groups, as well as managing relationships with railroads and rail car owners. Sean graduated from Iowa State University, which of course, Mark Houston is the real Harvard of the Midwest. With a degree in transportation logistics, he started his career at DeBruce Grain in the rail transportation group. And prior to the Andersons, Sean was Director of Transportation at Gavilon. With that, I'll let Sean introduce our panelists and I'd like to thank everyone for their participation. Thank you.
Thank you, Shane, for the introduction, and thank you to the National Grain Car Council for the opportunity to moderate the panel today. Before we jump into the questions, I just want to introduce our panelists. The first panelist is Ross Trenadue. Ross works for the Zeno Grain, where he's a manager of transportation in addition to working on Zeno's soybean export desk, focusing on truck, rail, and barge origination. Additionally, Ross has day-to-day tasks ensuring Zeno has adequate soybean supplies for the export program and export terminal located in Convent, Louisiana. Ross started his career working for Consolidated Grain and Barge in Cahokia, Illinois, learning the fundamentals of grain trade, and worked his way down the river to his current position in Mandeville, Louisiana. When Ross isn't chasing trucks, trains, or barges, Ross is chasing his 3- and 4-year-old sons with his wife, Rachel. Sitting here to my left is Ross Edwards. Ross is a vice president of transportation at Gavilon Group, LLC, a leading commodity management firm located in Omaha, Nebraska. He's responsible for managing the network of relationships and technologies to drive improvements in transportation and logistics across the company's grain and ingredient businesses. Edwards began his career at ADM as a commodity trader before working at BNSF Railway as a market manager in the agricultural products department, focusing on feed grains and unitizing the DDG portfolio. Most recently, he acted as a senior merchandiser at Gavilon, where he traded Gavilon's P&W, soybean, and corn positions and managed secondary freight. Edwards graduated from Texas A&M University with a Bachelor of Science degree in Ag Econ. Sitting here to my right is E.G. Hurl. He's a vice president of grain and logistics at GrainCraft, responsible for hedging, risk, and procurement. E.G. began his career at DeBruce Grain as a merchandiser. Throughout his career, E.G. spent time at Farmland Grain, ADM Grain, and Cereal Foods, where he held a number of different positions, including cross-country trading, HRW manager, hedging, and procurement. E.G. graduated from Kansas State University with a bachelor's degree of Ag Econ. With that, it leads us to our first question, which will be for Ross Edwards. Ross, we've experienced the delays caused by the congestion at the Mexico gateways. Can you talk a little bit about how this has affected the industry and share your thoughts as to how long these delays may last?
Yeah, thanks, Sean. I appreciate the opportunity to speak, and thank you to the Grain Car Council and to the STB. As most Western shippers can attest to, there has been congestion and issues at the various Mexico gateways. The issues have been for a combination of reasons. They've been MOW, maintenance and way related. There's been weather issues causing service interruptions. And south of the border, there's been numerous derailments that have really thrown a red flag into when you're trying to ship south of the border. Also, once in Mexico, there's been a lot of congestion in various areas. Overall, I'm hopeful that the problems are more episodic than systemic. On a better note, I do think that the connecting railroads are in constant communication, and the Mexican rail lines are working to expand to try to get rid of some of the congestion. Overall, I do think this is going to be an issue that we're going to see every now and again for the next 6 to 12 months, and so we need to keep an eye on it.
Okay, thank you. Continue to hope it gets better and work towards it. Ross Trenadue, we had a pretty robust export program last year, and as China continues to be a buyer in the market recently, it looks like we may have a big export program again. Can you talk a little bit about how competitive the U.S. is with the rest of the world and touch on any logistical challenges you foresee in the Gulf this coming year.
Hello, hi Sean, hi everyone. I hope everyone was paying attention to Ankush's presentation because he touched on a lot of the things that we have going on today. China has been a large market participant over the last 12 to 18 months. Really, the export boom started with China about 12 months ago. We started seeing China come to the market due to low commodity prices and taking kind of restocking from 2 years being absent from various factors in China. Currently today, excuse me, so just for some quick numbers from last year, we had record exports for soybeans to China, soybean exports in general, and we also had strong corn exports to China. The soybeans just out of the U.S. Gulf were roughly 33 million metric tons, which was a record. And PNW was at just north of 13 million metric tons, which was just shy of the record from 2016-2017 crop year. This year, looking at corn, as we close out corn to China, we're projecting roughly 20 million tons going to China, with 12 of that coming from the U.S. Gulf and roughly 5 million coming from the PNW and the rest coming from the other ports. This year coming up, the marketing year that's starting soon, we do have maybe not as much opportunity because of many different factors. One which was touched on earlier is the very high ocean freight. To put in perspective, when we were putting the program on last year for beans, for example, to China, roughly we were starting the program at $40 a ton to China. Today, out of the U.S. Gulf, it is roughly $85 a ton, which is just in pure shipping costs, almost $2 million more to ship the same cargo year over year. The same price spreads are similar to that off of the PNW, where we were shipping at $25 to $30 a ton. This year, it is somewhere closer to $40 to $45 a ton. So a large increase in prices there. In addition, we have a large crop that we perceive to be that will be planted in Brazil shortly and harvested in the start of 2022. The price spread between the two is substantial to the fact that if the Chinese or the world destinations can hold on to take as little as possible between now and new crop Brazil, that price spread is over $1 per bushel, which again on a per vessel basis is roughly another $2 million per cargo. So just very real dollars. But we do have a window, and there is good things to happen. We are expecting a good exports from to China and in general for soybeans and corn. Currently on the soybean front, the PNW is the low-cost provider of soybeans for October through December, January, in large part because of the freight spreads between the two ports, U.S. Gulf and PNW. When we flip over to corn, there's a lot more competition this year, and for going shipping to China. In large part, the U.S. Gulf or the USA is not the low-cost provider. Currently, Argentina and Ukraine are the low-cost providers, so we will have some competition with them. The good thing is that we have roughly 10 million tons of corn on the books for China this coming marketing year, and market expectations are that China will put on another somewhere between maybe 2 to 10 million tons. So hopefully we can get them up to 20 million tons, and the market will come in our favor to have another good shipping season. Thank you, John.
All right. Thanks, Ross. Appreciate that rundown. Next question is for EG. EG, we're going to see some interesting wheat crop. We're going to see an interesting wheat crop this year, along with some non-traditional movements. Can you talk a little bit about the wheat crop and maybe shed some light on the non-traditional movements we may see this upcoming year?
Hey, thanks, Sean, and thanks for the opportunity. Good to see you all today, and hope to see some of you at the reception later on tonight. Just a quick overview of the U.S. wheat crop. You know, in the East, we in general, we had better production, better yields. Some of it was hurt quality-wise with some late rains. So we had some falling number issues on some of the soft wheat crop in the East. In the Southern Plains, the HRW crop in general was high yields, low protein. As we moved north and west into Colorado, Kansas, and western Nebraska, the protein improved a little bit. Spring wheat crop, as we move north, obviously everybody knows about the drought that we've had in the north and the northwest. So, you know, smaller yields, higher protein would be a good way to characterize it. And then the PNW states, Montana, Idaho, Oregon, Washington, you know, pretty rough in those areas, and yields in general on all wheats produced in those areas are lower this year. So wheat movements, you know, that we're kind of seeing, obviously the exporters are seeing it too. You're going to see HRW, lower protein HRW, or even 12 Pro HRW move out into the PNW area, whether it's for export blending or into the domestic mills. We're seeing some lower protein HRW move straight north, which is very unusual. But with the mini KC spread where it's at today, you know, we'll probably see some of that go on. Obviously, blending lower protein winters with spring wheats is going to be a big deal this year. And, you know, potentially we may even see some soft wheats from the East move west. And that's, you know, that's very unusual. But those are just kind of some of the unusual moves that we're seeing, you know, this year in general.
Okay, thanks, EG. Appreciate that. Kick it back over to you, Ross Edwards. With rail logistics being such a big part of the successful execution of the grain trade, can you give your thoughts on the Western Railroad's current performance and any potential issues you see for the 21-22 crop year?
Yeah, thank you. You know, it's going to be an interesting end to the crop year, as some of the issues that we've had in terms of velocity with the railroads is masked by the weak demand because there's just low supplies of grain right now. Focusing on the UP, fires in the PNW severely impacted their network. The enormous amount of reroute miles and pressure put on crude boards was immense. But I had to commend them on quickly getting the bridges that were burned back up and going in all the rail lines for having to deal with the fires and be able to move past that and continue to operate admirably. When I first look at new crop, I like to look at the amount of car supply. The DN is projected to run approximately 155 shuttles, along with about 20 direct Ds. The UP is going to run around 80 shuttles, while the CP will have 94 shuttle sets in the US and Canada combined. I think all those records combined probably represent, if not a record, certainly the high end of that level. An area of concern, what we might see is over the next 30 to 45 days, a quick ramp up from the number of shuttles running today to October 15th could be an area where the railroads could stub their toe a little bit, but they're well aware of the issue and been trying to do things to get up and ahead of it. Velocity is going to be a key metric to gauge the amount of freight supplied. There is some concern around the amount of railroad employees, specifically the train and engine employees that are available. The railroads aren't immune to some of the issues that the larger economy and COVID, and that's put a strain on the number of T&E employees that could be out there. If we compare the amount of T&E employees to 2019, because 2020 is just a bad analog year for going back and looking at things. According to the STB, the UP and BN have approximately 76 and 84% the amount of employees respectively as they did in 2019. As Ankush pointed out earlier, if we layer the issues in the intermodal sector on top of that, there is room for concern. LA and Long Beach, the vessel parking lot, as I like to call it right now, there's 125 ships sitting out there, and it's got the attention of the Wall Street Journal and a 24-hour news network. So there's a level of trepidation in shippers' minds that during harvest, October and November, resources could be consumed in the intermodal sector at a time when we might need them for the ag sector. So that's something that we all need to keep our eye on. But once again, the railroads are well aware of this issue, and we've seen them talking to consumers of freight like us about pre-positioning sets doing forecasting and get up and ahead of the issues.
Thanks, Ross. Just kind of a follow-up question. You'd mentioned some service concerns with the Western railroads. With the drought that kind of EG was talking about in the north, can you expand on any thoughts on non-traditional moves for corn and soybeans?
Yeah, this is actually starting to be a very unique year. Now, there's no 2 years alike, but the drought in the Dakotas and Minnesota, combined with a really wide NOLA PNW ocean freight spread that Ross talked about, could have the propensity to have a wider arc of grains moving towards the PNW. If we focus on the CP for a second, I think you're going to see, because of the extreme drought that's happened in the Canadian prairies, there's already going to be a large portion of either whether it be corn or feed products move into the feed markets in Lethbridge and Saskatchewan and like places. So if we, between those two, there's just going to be some movements that we haven't seen in a couple of years and that the railroads are preparing for right now.
Okay, great. Ross, trying to do. So we've talked a little bit about EG and Ross Edwards both talked about the northwest drought. You want to just kind of talk about a little bit about the crop out east and what that looks like and any challenges we may see?
Sure, there is a bright spot. If you look at the drought monitor, it is not dry in the east, and crops look very good east of the Mississippi River, the heart of the grain belt, down into the southeast part of the country. Things are looking very good, and we're all very excited to start getting into harvest here. Corn harvest will likely start somewhere between 10 and 15 days from now, and we are expecting, if not record, near record production for many of the states there in the eastern grain belt. Having said that, we as shippers and receivers both have some concern about the velocity that we have experienced during this current crop year and what we will expect coming into what we will have for this coming crop year with larger supplies in the east. As many of you are aware, velocity has been up and down with both the major class ones in the east, CSX and the NS, and it's not only on the unit trains but also the single cars and first mile, last mile. And we're hopeful that this afternoon's reports will tell us that that the eastern roads are getting prepared for a large harvest coming in the east, and it should be a very busy 21-22 crop year in the east. Having said that, and to kind of comment with the rest of you guys about the non-traditional moves, this year with the PNW draw that Ross mentioned, pushing so far into past the Dakotas and Minnesota and maybe into Nebraska and Iowa, some far is Illinois, is likely that we'll see some of this surplus crops in the east want to work more towards the west and maybe flow to the Gulf and even all the way to the drought areas that were mentioned earlier in the Canadian Western Prairie. So it will be very interesting. So we'll tax both cars and powered with potentially longer trips than what we're accustomed to. So look forward to positive reports here later today from the groups that we'll be able to get velocity we're all happy with and cruising right along, ready for this exciting harvest coming up in 21-22 crop year.
Thanks, Ross. Appreciate that. And I recently had a trip that I drove out to Toledo, Ohio from Kansas City and stepped to some of our elevators. And pretty much the consensus we got was how good the crop looks everywhere. The guy that I was traveling with, was seasoned trader / farmer, was excited about the crops all the way out there. So from what we could see from our interstate and a few times we did get lost, the crops out there look good between Illinois, Ohio, and Indiana. So, all right, last question is for EG. So Ross talked about how the labor shortage is affecting the railroads. Can you maybe talk a little bit how the labor shortage is affecting the trucking industry and the effects it's having on our industry?
Yeah, so, it's really affecting us on both ends of the flour mill. So, as far as the inbound purchases by truck, we're basically having to double buy in some cases because trucks are slow getting there. Trucking companies can't find drivers, so it's affecting us there. I've got a couple of instances where a couple of our large suppliers have said no offer for 60-day shipment because they just do not have the transportation and the drivers to haul anything nearby. So that's a little concerning if you need to buy nearby wheat. On the outbound side, it's probably even worse. We've had to tell some customers, that we can't sell additional flour for spot because we just don't have the trucks to haul it. And we're real worried about trying to take on any new business just for the pure fact of we're not sure about executing it. So there's some cases where our trucking companies that are hauling our outbound flour are giving signing bonuses and doing anything they can to hire drivers. And it's, so it's not the equipment piece, it's the driver piece is the huge shortage. So it's an issue. And we're on the cusp of fall harvest, so we don't see this getting fixed anytime soon, really.
Take some of those 5.4 million people that are unemployed and put them in trucks.
Exactly.
All right. I think that's all we got. I think Michael put something out to see if there's any questions.
Yep, that's right, Sean. Just waiting for some questions to come in. I thought I saw a hand raised for a second, but I think you guys might have answered that question.
All right.
Yeah, I think we are all good. Thank you very much.
All right. Thank you again.
Okay, thanks.
Actually, sorry, we do have one question before you go. From board member Michelle Schultz. How do shippers intend to handle the trucking shortage, and are there any steps that they can take?
Well, I can tell you this, this has just been going on this week. We've had a couple of instances where, we basically had our whole transportation group hitting the phones, calling different truck lines, seeing what we can do to help. Do we need to help with, any signing bonus, anything? Because, it's imperative that we ship flour to our customers. So, it's a real deal, and it's hit home for us this week in a pretty big way. So I don't know what the answer is, other than you have to figure out what that level of pay is to get drivers engaged. So that's the easy answer, I guess.
Okay, thank you. And we've actually got a couple more coming in, so maybe you guys should have cut out when you had the chance.
Ross trying to do was a lucky one, right?
Exactly. Although we could always call him back. There he is. So from Mark Houston, a question for Ross Edwards. What is your biggest logistical concern executing PNW export programs this fall?
Yeah, that's a great question. I kind of alluded to it in the conversation or the question earlier. I believe it's going to be the ramp up. Right now, if we look at it, I believe the BNSF is running somewhere around 104 shuttles. The UP, I believe, somewhere around 60. And so all of a sudden, if you move up to around 80 and 155 respectively over 2 weeks' time, and all of those get sent to the PNW all within about 5 days of each other, it's going to get backed up. And so that's the amount of coordination between the exporters and the railroads is going to have to be just on point for us to be able to move smoothly through the first 2-3 weeks of harvest.
All right, great. Thank you, Ross. And then one more question from Shane Barrett. Many of you mentioned the impact of the ocean freight spreads on PNW versus Gulf. Do you have any opinions on if that relationship will remain intact or if it will remain into next year?
Ross, do you want that one?
Yeah, sure, I can. I think that ocean freight will stay elevated. My personal opinion is that it will stay with us for a while. I think we have many non-grain factors that are tugging at ocean freight that we continue to see coal work into China and iron ore. We've had a hot overall, it's been hot. So I think we're consuming a lot of raw materials that take up bulk ships, and it's hard for me personally to think that we're going to see a significant sell-off and push us back into rates that we saw 12 months ago. And with prices being so much drastically cheaper in South America when we get to their harvest here, I would assume we would see more of a filling up period for at the end destination. So right now, I don't know what the P&W guys, Ross, has to think about that, but that's my opinion.
Thanks, Ross. And now a question for Ross Edwards from Jerry Cope. Have the railroads given any indication of how they might approach the non-traditional moves, such as south to north or east to west?
Well, I think it's a rapidly evolving situation right now. A few years ago, we saw where we were moving corn from like North Dakota into Illinois, and this year, you might see the reverse of that in some aspects. And so I think they're working right now diligently, both the CP, UP, and BN, about fielding from us, the customers, all the different various demand points that we're starting to come up with, and working with their operations team to see what's available. So I guess that's the best way I can answer it, is it's happening super rapidly right now, and they're working with their operations teams to hopefully make it happen.
All right, thank you all. I think those are all the questions that we have. And so next, I will turn it back to Jared Farmer.
Thanks, Mike. Am I on the screen now? I can't tell.
Yes, you are up.
Oh, there I am. Okay. Thanks. I want to thank the shipper panel, all the presenters, really educational, Nate and Ankush. And I hope everyone found that engaging and educational as I did. And we're running a little bit ahead of time. We're probably a little more than 15 minutes ahead of time. That said, we're going to come back after the break with officer nominations, and then jump into the rail equipment overview after that. I would say in an effort to maybe finish early, let's take a break now, and why don't we come back at 3? The original agenda said 3:15. We'll reconvene at 3 with officer nominations, and we'll go from there. Okay, we're back. It's 3 o'clock. We will jump right into officer nominations. And so I will start by saying that I am changing positions within CP. My areas of responsibility are changing. And after about, well, more than a decade in the US grain business with CP, I won't be in it anymore. I'm taking on some different commodities within our sales team. And so I'm resigning the chair of the National Grain Car Council, as I won't be in theory at the meeting next year. And so we'll leave that up to some others to plan and execute successfully. So I did get to be chair of the 2 virtual pandemic meetings, which was exciting and fun. And just want to thank everybody who supported me through that. And I was kind of thrown into it myself when the previous chair actually resigned, and I took over in my first year, and we worked through the pandemic. So a lot of fun, and we can just move now, I think, to the officer nominations, and I'll start with the nomination for chairman of the National Grain Car Council. And there was email nominations, so I'll read off the email nomination, and then I will ask for any other nominations that might be brought forward. And if there are no other nominations, the nominee will be elected by acclamation. And if there are other nominees, then Mike Small will send out email ballots in the case where there's multiple nominees. So first off, in the role of chair, Shane Barrett, who is currently vice chair and did an excellent job with our shipper panel this year, is nominated by Alan Koenig of Graincraft for the chairman position. So Shane, I'll ask you if you accept the nomination for chairman of the National Grain Car Council.
Yes, I do.
Thank you. And then I will ask, are there any other nominations for chair of the National Grain Car Council? Sounds like no. All right, by Shane, by acclamation, you are now the chair of the National Grain Car Council. Congratulations. Now the nominations for vice chair of the National Grain Car Council, filling in the position that Shane has just moved on from. We've got David Shinovic from the CN, nominated by Alan Foster. And we've got John Harmon from Canadian Pacific, nominated by myself. And since there are 2 nominees, well, first I'll ask David, do you accept nomination for the vice chairman position?
Yes, I do.
Thank you. And John Harmon, do you accept nomination for the vice chairman position?
I do.
Thank you. And so with the 2 nominees, I'll just ask, are there any other nominees for the vice chair position? Being none, Mike Small will distribute email voting ballots to elect the vice chair for the National Grain Car Council. Last, but certainly not least, is the nomination for second vice chair. Currently Mark Houston, whose term is expiring. However, he was renominated by Alan Koenig, and I would second that nomination. Mark Houston, do you accept the nomination for second vice chair?
Jared, I'd be honored to.
Thank you, Mark. Appreciate it. And I'll just open it up to the floor. Any other nominations for second vice chair? Being none, Mark, congratulations. You are again second vice chair of the National Grain Car Council. So with that done, I think, Mike, I will turn it over to, I think I'm done. Mike, there was nothing else there was. I'll just ask you, make sure I got that right.
Nope, nothing else. Everything went great. And I think now we turn it over to Mark Houston to
Sounds
introduce our
good.
next speaker.
Thanks, Mike. Mark, over to you.
Got it, Jared. Waiting for things to pop up. Here we go. Good afternoon, everyone. My name's Mark Houston. I work for Louis Dreyfus Company here in Kansas City, and I am your second chair on the board here. By the way, thanks for the support. It's my privilege to introduce our speaker today, who will provide us with a rail equipment overview as we go into the fall harvest period here. Dan Anderson is Vice President of Strategic Marketing and Product Development for Trinity, having spent a decade in the rail industry. In his current role, Dan leads Trinity's marketing and business development efforts. Before taking his current role, Dan was involved in market intelligence, corporate strategy, and government relations at Trinity. In his time at Trinity, Dan has been instrumental in focusing the organization on providing rail-based solutions to solve freight shipper supply problems and promoting rail as a sustainable, efficient, and safe mode of freight transportation. Dan has a Bachelor of Arts in Economics from the University of Michigan and a Master's of Business Administration from the University of Texas at Dallas. Dan, thank you for your and Trinity's participation in this conference today. Dan, we look forward to hearing your presentation. Thank you.
Well, thanks, Mark, and congratulations on the second vice chair role. Glad to see that. So good afternoon, everyone. I appreciate the opportunity to give you all an update on the railcar market. Thank you, Mark, for the intro. And as Mark said, my name is Dan Anderson, and I am the Vice President of Strategic Marketing and Product Development at Trinity Rail. If we could go to the next slide, Mike. What I want to do today is cover 4 quick topics. First, I want to give you a very brief overview of Trinity and some of the innovations we have introduced recently. Second, I want to provide an overview of the North American railcar fleet, focusing specifically on grain-covered hoppers. Next, I want to review the latest railcars and storage metrics to understand the existing railcar availability situation, and to top it off with a look at the recent railcar order and delivery trends to take the temperature in the new railcar market. Overall, what you will see is that there is a large fleet of covered hoppers in North America, and while storage rates have declined in recent months, there are still a number of covered hoppers in storage. Nevertheless, orders and deliveries for covered hoppers are growing. Before I dive in, my legal team has asked me to let you know that the information in this presentation and the accompanying views and analysis are based on publicly available industry sources and do not necessarily represent the proprietary information, analysis, or outlook of Trinity Industries, Inc. Mike, if we could go to the next slide. So if you'll indulge me for just a moment, I'd like to tell you a little bit about what's going on at Trinity. We'll go to the next slide. You probably know Trinity Rail as a large railcar lessor and manufacturer. Over the last 18 months, Trinity has been evolving to service our customers better with superior rail supply chain solutions. Today, we are focused on customer experience, expediting customer success through trusted rail equipment and logistics expertise, innovation, developing new capabilities and technologies to push the boundaries of rail transportation, platform efficiency, delivering our products and services with maximum efficiency, and people aligning our organizational structure, processes, and skill sets with these goals for our customers. Next slide, please. We seek to deliver on these goals with our platform, which we believe is the broadest and deepest in the industry. We design, build, own, manage, and maintain railcars cradle to grave. We bring the breadth of our experience to each of our products and services. So if you're purchasing a railcar from Trinity, that design has been enhanced by what we have learned maintaining similar railcars in our fleet to improve the total cost of ownership. If you're leasing a railcar from Trinity, your customer delivery manager and field support rep can easily interact with an engineer that designed the railcar and our maintenance team that repairs similar railcars across the industry, all to keep your cars in service. Every day, we harness the breadth and depth of the platform to deliver each of our products and services better for our customers. Next slide, please. I'd like to take just a quick moment to introduce two new offerings that I think demonstrate how we are taking the expertise we collect from across our organization to deliver innovative solutions to rail shippers in North America. We recently introduced the 5459 covered hopper, which is designed to move bulk commodities like grain more efficiently with more cubic capacity per linear foot. Here we combined our understanding of agricultural shippers' need for more capacity with a horizontal side seam technology we introduced in the early 2000s. We are also very excited about Trinsight, which takes lessons we've learned from years of shipping on the rails and turns them into a tool to give shippers more insights about their equipment and their freight to identify inefficiencies and improve the cost, complexity, and consistency of their supply chains. I encourage you to use the QR code to learn more. Next slide, please, Mike. So, sorry for the detour. Appreciate your indulgence. I love talking about Trinity almost as much as I love talking about the rail industry, which is, as we all know, the safest, most efficient, most sustainable way to move grain on land. So let's get into it. Next slide, please. According to the latest report from the AAR, there are 1.6 million rail cars in the North American fleet. On the left, you can see those rail cars broken down by car type. If you look at this composition over time, you'll see the growth of the tank car fleet as the gondola and hopper fleets have shrunk. The tank car fleet is very young compared to the aging boxcar, gondola, and hopper fleets. The tank car fleet is used to ship liquids and gases for the energy, chemical, and agricultural markets. Energy commodities include propane, crude oil, and fuels. Chemical commodities are abundant and diverse, ranging from ethylene glycol to chlorine to acrylonitrile. Agriculture commodities include fertilizers, animal processing byproducts, and food oils. Gondolas and hoppers ship coal, steel, and aggregates. Boxcars ship paper and food. Flat cars move lumber, pipes, and other large industrial goods, and vehicular flats and their associated superstructures move 75% of all automobiles produced in the United States. But today, we're here to talk about covered hoppers. According to the latest AAR report, there were 566,000 covered hoppers in the North American fleet at the beginning of August. Covered hoppers are differentiated by how they discharge their cargo. There are three predominant types of covered hoppers. The pneumatic covered hoppers are for freight like plastic pellets that can be in essence vacuumed out of the rail car. Pressure differential covered hoppers are for commodities transported as powders like flour and cement that can create a pressure variance between the interior of the car and the exterior and agitate product out through a complex piping system. And gravity gate covered hoppers, which use doors at the bottom of the car to allow bulk dry goods like sand, fertilizer, and grain to flow freely down out of the rail car between the rails. At the beginning of August, there were roughly 400,000 gravity gate covered hoppers in the North American fleet. Of those, 275,000 were more than 4,000 cubic feet, making them ideal for the shipment of grain and other grain-derived products. Next slide, please. Now let's look at how the size of those fleets changed last year. The overall revenue-earning North American railcar fleet contracted for the first time since 2010. That decline was led by contractions in the hopper, gondola, and boxcar fleets. In each case, there were many older assets that were reaching the end of their useful lives. In the case of gondolas and hoppers, the contraction was also exacerbated by the rapid decline in coal carloads, which made up more than 1 in 3 carloads in 2007, and in 2020 were less than 1 in 4. In the case of boxcars, demand for brown paper for cardboard production seems to have stabilized, if not helped to grow paper shipments. Thank you to all those who use Amazon and those brown paper or brown cardboard boxes that end up on your stoop every day. Railcar manufacturers have seen orders for boxcars recently to replace some of those retiring cars. The covered hopper fleet contracted slightly, While many aging suboptimal grain cars built in the 1970s and 1980s have left the fleet, new grain cars are being delivered, and the pneumatic fleet has grown with the expansion of plastics manufacturing capacity in North America. Next slide, please. This graph shows all the rail cars in the North American fleet by their estimated age, which is at the bottom axis. Despite the attrition mentioned in the last slide, the boxcar and covered hopper fleets still have meaningful populations of older assets that could retire in the near term. Over 60,000 covered hoppers are estimated to be over 40 years old, and most of these are large gravity gate covered hoppers currently used to ship grain and other agricultural products. Next slide, please. Now that we have some foundational understanding of the North American fleet and its composition, let's look at how intensely those rail cars are being used to ship goods. Next slide, please. At the beginning of August, just over 350,000 rail cars were classified as in storage by the AAR. The AAR defines cars in storage as any car that has not moved loaded in the last 60 days, but has moved empty since its last loaded move. The August number is down from the peak storage levels we saw last year during the worst of the 2020 COVID impacts, which was over 525,000 cars in storage. This decline can be attributed to both the increase in rail traffic from a strengthening economy and the fleet contractions we discussed earlier due to the high scrap steel prices. Current levels are near their 5-year average, but remain elevated compared to the last peak rail traffic in 2018, when rail cars in storage fell below 300,000. Next slide, please. The biggest drivers of the decline in the fleet and storage have been covered hoppers and tank cars, which makes sense given how large those fleets are. Some of this has been attrition, as we discussed earlier, but from a demand side perspective, the overall economic recovery has supported improvement in energy and chemical carloads. Through the worst of the COVID lockdowns, agricultural traffic actually fared better than most other segments, thanks to strong grain exports and elevated food demand. Next slide, please. Looking at the fleet just of covered hoppers in storage, it has fallen from over 170,000 to just over 120,000. This improvement has not been as stark as we have seen in other markets for two key reasons. First, as I just mentioned, the COVID-related increase of cars in storage was not as significant in covered hoppers as it was in other fleets due to the steady to strong performance of agricultural shipments last year. Also, the recovery of the frac sand and plastics markets, which also move in covered hoppers, has been slower than in other markets like consumer goods and construction. Next slide, please. As the size of the fleet and storage has fallen, the interest in new cars is growing. Next slide, please. New railcar deliveries reached a multi-year low earlier this year. Covered hopper deliveries, however, reached their cycle low in the second quarter of 2020 at just over 2,300. Since that low point, quarterly covered hopper deliveries have averaged 3,200. Orders have been growing since the second half of last year, and covered hoppers have been a key part of this increase. Covered hoppers have represented over 9,000 of the orders since the second half of 2020. Next slide, please. Manufacturers ended the second quarter with just about 37,500 rail cars in the backlog, which was an increase from the 35,000 at the end of the first quarter. Of the backlog at the end of the second quarter, nearly 13,000 were covered hoppers. Next slide, please. That is all the content I had prepared today. I hope it was a good overview of the fleet, where it stands in terms of existing equipment, and the growing interest in new covered hoppers and new rail cars overall. I'd like to thank the National Grain Car Council and the Surface Transportation Board for the opportunity to speak with you all today, and I'm happy to answer any questions you may have.
Thanks, Dan. Let me just give people a couple seconds to type their questions if they have any. All right, and I think that we have no questions for you, Dan. Thank you very much.
Thanks, Mike.
Okay, so next we're going to move on to the railroad reports. First, we'll start with the Class 1 reports, followed by the Class 2 and 3 reports. First up for the Class 1s is BNSF, so I'm going to turn it over to Todd Glissman and Jim Titsworth.
Well, good afternoon, everybody. This is Jim Titsworth. Just making sure that you can see me and everything. So good afternoon. Thank you for the opportunity to speak with you all today and give me an opportunity to tell you about BNSF as we approach another really great harvest. Going to be a little bit of a different harvest, as we all have talked about, but another good year. And the central theme for today is that BNSF is ready for that harvest. The most important thing we can say is thank you. Thank you to the producers who do such a great job every year. Thank you to our customers for the business that you have given us. And thank you also for your confidence in us by making your investments on BNSF. We appreciate that very, very much. We mentioned on our email response that BNSF is well prepared for harvest. We have recalled many of our employees to active service. We are actively hiring in some locations, and we are adequately staffed for the forecasted volumes. We have nearly 5,000 active locomotives and an adequate reserve in storage. As Ross mentioned earlier, we have 32,000 covered hoppers and will operate about 155 dedicated sets of BNSF equipment for our unit train customers. And we'll also meet our demands of the single car shippers as well. We have continued our solid 2020 turns per month performance throughout 2021, and we expect to continue to do so. We continue to invest heavily in our railroad, spending about $3 billion this year and over $70 billion in the last 2 decades. That's resulted in the very best condition railroad that we've ever seen. One of the questions was, how will this be different than previous harvests? Well, we're going to make strong efforts, as we always do, to prepare and to execute in harvest. Our safety performance is better than ever and continues to improve. We are currently tracking at record low incidences on our way to what we firmly believe is an injury-free workplace. Like most years, our extensive capital maintenance program will conclude prior to harvest in our key high volume grain corridors. This is something we plan to do every year. And this year in particular, it will be very important with the ramp up that we are looking at. One difference from last year to this year is we have many cars in storage going into this crop, whereas last year we were benefiting from strong stocks and a strong market, and those cars were already out and running. So as mentioned, we are facing a steep ramp up to pull those cars out of storage and get them operating. Helping that overall process, we've been working proactively at car repair this summer, doing wheel changes, upgrading air brake valves, all of this to be ready for not only harvest, but for winter as well. Technology is also allowing us to reduce delays in our inspection processes as those trains are cycling. We will have a very strong ramp up period this year. We are ready with pre-positioned cars and locomotives and adequate employees. We have a long history of an aggressive capital investment program that has resulted in high quality and a capacious network. We continue to address bottlenecks as our business grows and changes. Probably the most visible of that to the grain industry is the completion of our Sandpoint Bridge project here coming up in just a couple of years. That's a major project and will add to our performance and capacity on our key Pacific Northwest corridor. Thank you for those of you that supported the construction of that bridge. We're adding double track on our Southern Transcon to support growth and to further the efficiency of our domestic and Gulf and Mexico customers. And we're continuing to invest in our covered hopper fleet to ensure not only availability, but quality. In summary, we're planning for a near record grain and grain products crop year, despite the well-known production issues. The railroad is prepared with the best network we have ever had and adequate cars, locomotives, and people. A very rapid ramp up as the crop comes on will be a challenge, but we're prepared for that. And we thank our customers for proactively communicating with us to make that process work even better. Crop dislocations, as mentioned earlier on the panel, will cause movements that are out of the ordinary. Our customers and ourselves will efficiently adapt to that reality as we always do. Our customers are heavily invested on BNSF to create a highly efficient supply chain that delivers what the market calls for. And that will be seen again this year. Thank you for the time and the opportunity today.
Thank you very much, Jim. It looks like we have a question from Chairman Marty Oberman. Go ahead, Marty.
Thanks, Mike. I'd like to ask this question, Jim, but I really would ask all of the railroad representatives to speak to it. And that is, you know, we've had many issues over the last year involving crew shortages across the networks, not focusing on BN or any other railroad for the moment. What I'm wondering is, where are you on having enough mechanics and electricians to get locomotives up to speed as they come out of being mothballed for the grain harvest? And do you have enough people in those categories to make sure you'll have I know you have tons of locomotives, but do you have enough people to get them ready to go for the grain harvest? And I'd like everybody to address the same point if they could.
Yes, I mean, that's a very insightful question because a lot of times we focus on just the number of locomotives, but bringing those locomotives in and out of service is not a small undertaking, and that does require the mechanical forces to store them properly and to also bring them back into service properly. We have obviously adjusted our employee forces through the COVID slowdown and brought them back in line with those locomotives as they come back online. You know, a lot of focus goes into the TY&E folks that actually operate the trains, but the mechanical folks behind that are just as important. And we've adjusted those forces as well. So we don't see any concern with bringing the locomotives back onto service that we need throughout all of our forecasted volumes for this harvest and into 2022. So thank you for a really great question.
Okay, Jim, I think those are all the questions that we have for you.
All right, great. Thank you for the opportunity.
Actually, Jim, sorry, we got one more from Greg Twist. He would like to know not only fleet and locomotive counts, but how do they compare to last year?
I'm sorry, Michael, you froze up there at just the wrong time. What was the question?
Sorry about that. Greg Twist would like to know not only the fleet and locomotive counts, but how do they compare to last year?
Fleet and locomotive counts. Overall fleet of locomotives, I think, is probably flat to last year. I don't have those numbers in front of me, but fleet of rail cars has expanded over last year. You know, we expanded the fleet last year to adjust for the demand that we saw, and we've really not returned that fleet to a smaller size. You know, we are anticipating another basically record year in grain and grain products at BNSF. And that fleet really is sized to support that.
Okay, thank you. Next, we have a question from Robert Prentice.
Yeah, Jim, just real quick, what is the lead time for you to bring equipment out of storage? So how much time are you going to need to rebound? So if there is a spike, how quickly can you adjust to that?
Right. So in the grain business, we have strategically pre-positioned our storage cars right now very close to the origins. So it's just a matter of days to do that. That's something that we do every year. It's just a matter of normal course of business. So that's not an issue. We've also, we are building right now our pre-positioned locomotive fleet. And so that will be just a matter of days as well. So we are very well prepared for this ramp up. Thank you for the question.
And just follow up. So does that take into account any of the potential changes that may come about in terms of, as people have talked about, different movements that may result because of this type of harvest that we've had this year?
Right. We're already seeing those different movements now because of the stocks that are out there and because of the harvest that's coming on. Those different movements are something that are probably greater this year than at other years, but we continuously adjust to that. That'll be all part of the normal course. We don't see an impact from those different movements on how our performance is. So not a measurable concern.
Okay, thank you.
Thank you, Michael.
Okay. Thank you, Jim. I think that's all we have for you. So next we will go to Canadian National with Alan Foster and David Shednovic.
Good afternoon, everybody. Thanks for your time. Can you hear me all right there?
Yes, yep, we can hear
Very
you.
good. Thank you. Just wanted to double check. All right, well, very good. Just getting into the brass tacks here of the resources that we do have in place at the present time. Seeing as we've had a previous question about kind of comparables year over year, I'll speak to that as well. Concerning locomotives, CN had a fleet of about 1,900 high and mid horsepower locomotives as of late August. That compares to 1,925 at the same time last year. We've got about 75 more locomotives in storage than we did it last year, at which last year was about 175. We did acquire 75 new locomotives this past spring, of which we've taken delivery of 25, and the remaining 50 will be received in early 22. So you add those 50 on, you can see the locomotive fleet's going to be a little bit bigger year over year once we get into early 2022. From a crew perspective, T&E perspective specifically in the United States, CN's T&E as of mid-August stood at about 2,500 employees, just over, of which about 2,400 were active. We had less than 100 T&E on furlough in the US as of mid-August. The vast majority of those were outside the core grain traffic area, so we're feeling pretty good about crew resources going into the harvest time here. From a fleet perspective, the overall fleet that CN has for grain service this year, both sides of the border, of course, around 13,300, of which approximately 1,400 will be focused primarily in grain service or available for grain service in the US. That's both for unit train and manifest. Just to touch base on the capital program, we've been investing heavily. Both sides of the border didn't take our foot off the gas as a consequence of COVID whatsoever. Our capital program for 2021 is about $3 billion, of which just under 500 million was planned for the United States. So capital program continues there to increase network capacity. Concerning some of the specific questions that we got, I guess I will mention as well that part of the capital will being deployed besides the locomotives that I mentioned earlier. We've announced the acquisition of another 1,000 new high capacity hopper cars. That will be 3,500 new acquisitions since 2018. That 1,000 car order is part of a larger 3,500 car multi-year order. That'll bring the fleet down the road to 6,000 cars, and we'll take delivery of those 1,000 new hoppers in early 2022. As to the specific questions, how do you expect the railroad's grain program to differ from last year's? Well, going to be very material differences concerning the overall amount of grain available for movement, particularly in the prairies in Western Canada. Of course, a very extensive drought there upon which everybody's very familiar. You know, a different story in the Midwest, thinking about CN's core draw. You got the pull from the east. Illinois is looking at a good crop. Wisconsin looks good. Eastern side of Iowa. You know, there are some dryness issues, of course, on the western side of Iowa. We had a very damaging storm actually go through parts of eastern Iowa last night as well. I'd mentioned 100-mile-an-hour winds, so stuff happens. But yeah, I mean, from the perspective of how the program will differ versus last year further, I mean, we do expect to see some trade flow shifts. I already mentioned the decline in volumes in Western Canada we can expect. We'll see how the Gulf versus PNW spreads play out. We do expect south to north moves as well, and those are moving in lanes in which we have network capacity to move that, and we've been working on those moves for quite some time now to facilitate that up north. So we are feeling like we're in very good shape there. Concerning crew readiness and the question specifically about labor issues, CN has no crew staffing issues relative to plan at this time. No issues attracting candidates for crew positions at this point. For Q3 hiring, CN's got candidates in place in Illinois, Michigan, and Iowa. I just looked at the T&E numbers as a percentage of June of last year. We're at about, looks like we're at about 118% T&E compared to June 2020 when we saw the trough, of course, for the decline in overall traffic as a consequence of the pandemic. As of relative to January 2021, we're actually very flat, just under 100% of the T&E complement as of versus January. To speak to Chairman Oberman's comment there, we do feel, as was the case with T&E, that we have the sufficient resources from a mechanical perspective and elsewhere to deploy locomotives that we may have in short-term storage or long-term storage. The same comments apply as they would to the T&E that I advised of. I've spoken to the crew and locomotives already. Have your operations been affected by the Delta variant? Well, I'll speak to COVID here generally. I mean, there's been impacts to all kinds of customers on this call, obviously class 1s, going back to the onset of COVID back in March 2020. You know, we continue to implement and enforce strict precautionary measures, including regular sanitization of common surfaces, social distancing, mandatory masks across the network. We are continuing to adhere to the local public health guidelines across jurisdictions and encouraging all of our employees to be fully vaccinated. Concerning current bottlenecks that you may or may not be experiencing, no bottlenecks at the present time. So with that, I'll just conclude my comments and leave it open for questions.
Thank you very much, David. We have a question from Ross Trenadu. The new equipment that CN is acquiring, will the equipment operate in the US or in Canada?
Yeah, I'd say that really depends on demand. Principally, the equipment has been deployed primarily in Canada. We've had fleet in place in the United States to meet the demand that we have been experiencing. And we'll see, you know, depending on how the demand situation goes here this year, whether or not more of that high efficiency, high capacity fleet gets deployed in the US.
All right, thank you, David. Just giving a second for more questions, going once, going twice. I think you're free. Thank you very much.
For your time very much.
Okay, our next Class 1 railroad is going to be Canadian Pacific. So I will turn it to Jared Farmer and John Harmon.
All right, thank you, everybody. Start out, CP is well positioned and ready to move this year's grain crop in both US and Canada. And I'm pleased to report that last year up north, we moved a record crop and set a whole bunch of all-time company records. And we still have a lot of those assets. So if you're buying, we're selling. And now looking ahead, we're monitoring the dry conditions across the prairies and northern states. Given the drought, we are all expecting less overall demand versus last crop year. However, we're forecasting normal peak demand levels, and we have offered at least the same amount or more of shuttle capacity to our shippers. Today, we have 5,000 CP owned and leased new high-capacity hoppers in active service, and we operate one fleet, so they're all mixed in across North America. CP is investing $500 million over 4 years to purchase 5,900 new high-capacity grain-covered hoppers, and these new hopper cars are already providing a significant capacity gain for CP. We're moving an additional 3 metric tons more per car since the beginning of the fleet replacement program. In total, CP has committed to acquiring and leasing a total of 7,400 new hopper cars by the end of 2022. We've undertaken a robust locomotive modernization program and have modernized 386 high horsepower mainline locomotives in the fleet since 2012. Equipped with the latest technology, these locomotives are significantly improving reliability and performance. To further meet the needs of North American customers, CP is hiring 850 T&E employees during 2021, and currently we have 590 new operations employees in various stages of training. For the upcoming year, CP plans to make available approximately 1,050 to 1,150 locomotives in service. We currently have approximately 100 in strategic storage as surge capacity. Up to 15,500 grain-covered hoppers as well will be deployed, and 3,950 to 4,050 T&E employees. And to put that in perspective, last crop year, CP made available 1,000 to 1,100 active locomotives, the same number of grain-covered hoppers, and 3,600 to 3,800 T&E employees. CP's headcount is actually up year to date versus 2020. We proactively manage resources through any volume environment as part of our operating model. When it became clear that we would need to rapidly furlough a significant number of employees because of the unprecedented pandemic, we worked with the unions to top up benefits for furloughed employees in order to reduce the callback time from 2 weeks to 72 hours. This action helped maintain the relationship with our employees in a time of uncertainty, and CP was able to move a record amount of grain last crop year throughout. With the drought this year leading to a smaller crop, we are confident we have the resources to move the business. As reflected in our Q2 21 earnings report, our operating performance continues to improve. Train weights and lengths improved 1% and 3% year over year respectively and are at all-time records. Cycle times from origination on CP and the US Upper Plains to the PNW are expected to be 2 to 2.5 trips per month. While we experienced some network disruptions in July as a result of forest fires in BC, we have returned the network to a fluid state and are working closely with the regulator to ensure we are providing the support to fire identification and suppression efforts. CP expects the total 2021 system-wide capital investment to be approximately $1.55 billion. This significant investment builds on our record 2020 $1.67 billion capital program as we pulled capital forward in order to maximize efficiency in the low volume pandemic environment. CP is investing more than 20% of its revenue into our capital program. Regarding PTC, Canadian Pacific is fully compliant. And then lastly here on COVID-19, throughout the COVID-19 pandemic, the health and safety of CP employees has been at the heart of our decision-making process. CP is steadfast in our commitment to protect employees while serving customers and the communities that rely on our network. CP's actions included early policies restricting work travel and enforcing self-isolation for personal travel, the implementation of a dedicated COVID-19 resource line to address employee questions and concerns and to assess employees 7 days a week, a face covering policy, educating employees about the importance of proper hygiene and physical distancing, implementing a work from home initiative for employees not in critical operations or operations support roles, and enhancing workplace sanitization products and methods. CP is proud of everyone's efforts to ensure the health and safety of employees while maintaining safe and effective rail operations. COVID-19 has not created staff shortages at CP or impaired our ability to provide critical transportation services. Thank you all for the opportunity to speak, and thank you to all of our customers for the business they bring us so we can continue railroading every day. And I'll open it for questions.
Thank you, John. Let me just give people a second to type their questions if they have any. All right, I think there are no questions, John. Thank you very much.
Thank you.
And next we will go to Ted Johnson and Jack Veerling of CSX.
Everybody, my name is Ted Johnson. I am the Director of Marketing for our Agricultural Products Business Unit. I've got here in the room in Jacksonville with me as well, Jack Veerling, who last year he was our head of car management. This year, he is in a new role. He's our head of crew management. He also has responsibility for our bulk desk and bulk operations. So he is here to support me as well. So as you heard in the shipper panel, we are expecting a very busy harvest season in the East, very good crop. But as you also heard, we are and have been seeing some of those real labor stresses that were discussed. Crew availability has been our primary challenge over the last several months across both the grain network and network wide. So it'll be the most important thing that we're keeping an eye on and endeavoring towards, as we're also seeing growth across all other business units at CSX. That said, CSX is doing everything it can to prepare for this coming harvest and meet all the freight demand in the agricultural product space. So let me talk about crew, since I've kind of highlighted it as our real focus. As you see in our metrics, we have about 6,900 active T&E employees with under 1% furloughed. As of a couple of days ago, we had only 31 T&E employees in furlough, mostly in just 2 specific locations. We are at about 100 more active T&E employees than we were last year at this time when we spoke at the National Grain Car Council. We're trying to get as much availability out of our current T&E base as possible, and we're trying to hire additional manpower. So let me cover availability first, and COVID. COVID has definitely affected our crew availability. As of today, we have 192 T&E employees that are off for COVID-related reasons. And so as the pandemic spikes and ebbs and flows, hopefully we'll get those employees back and get that level down sooner than later. But regarding the rest of the T&E base, CSX is offering vacation buyback, as well as some very aggressive attendance bonuses to incentivize the current workforce to be as available as possible and remain marked up. When it comes to hiring, we're doing everything we can to hire. Our goal is to have 3 classes per month of 40 trainees, so 120 trainees a month. And we're going to do that through the end of 2021, as well as into 2022. So far this year, we've hired 475 conductors, and most of those are still in training qualifying and will come into service in the next couple months. The hirings across all locations, not just the grain, primary grain areas. And it's not just to backfill where we have shortages now. We're trying to get ahead of future attrition and future growth. We're also offering sign-on bonuses, as well as employee referral bonuses to incentivize full training classes. So that's kind of where we are with regards to crew. Our service metrics have been impacted by crew availability over the past couple months. As you see, you can look at our velocity numbers that we submitted with the metrics, but essentially dwell is a couple hours above 2020 levels, and velocities a few miles per hour lower than this time in 2020. Not significant, but it's definitely had an impact on the metrics. When we turn to other resources, we don't have any issues there. We have sufficient locomotives and car resources available to meet all the demand. As you see in the metrics we submitted, we've got 2,300 active locomotives, 50 that are available to instantly deploy, and more than 400 in longer term storage. That's about 100 active locomotives additional versus this time last year. And to go to Chairman Oberman's question, we do not have any issues with the mechanical staffing levels regarding the ability to pull those extra 400 locomotives out in a good amount of time. We don't expect our current program or our program this year to be much different than the last few years. We expect to run between 40 and 50 unit trains at any given time. We have a fleet of over 3,500 covered hoppers with a significant amount still in storage. And so the capacity that we have from a car standpoint exceeds the demand that we think we will see. About 80% of that equipment that we run will be in unit train service. We continue to focus on our grain origin and grain receivers that have express rated capabilities. They can load and unload in less than 24 hours. And we have financial incentives for the majority of our grain to originate at locations with those capabilities. And lastly, we're entering the 4th year of our train commitment program, which allows our customers the complete control of a railroad set for a full year in exchange to keep the cars running. And it's created a secondary freight market that we haven't quite had here in the East as long as there has been out in the West. We expect about 23 of those committed sets to be in operation during this harvest, which is the same number as we had last year, up from 15 the first year. So that being said, we are cautiously optimistic that we're going to be able to handle harvest just as effectively as we have in the past couple of years, but we are guarded on the crew issue, as I detailed, and we're doing everything we can to make sure we can have the manpower necessary. So questions?
Thank you very much, Ted. I'll just give folks a second. All right, looks like you're all set. Thank you, Ted.
Thank you.
And next we will go to Kansas City Southern. So I will turn it over to Mike Biloveski and Dan Schuth.
Oh, good afternoon, everybody. Thanks for the time we can have here. So I'm not going to address the metrics that we sent in. I think everyone can read those. So I'll focus my remarks on the 4 questions that were sent to us. So, will we have anything different this year on a program than we did last year? The answer to that's no. As I've said before, I think everyone understands we really don't run dedicated shuttle trains, kind of like everybody else. So what we do is, as an empty train's coming north, we just try to coordinate with customer demand, open elevators, the size of the train, and then try to distribute the cars there. So, what we really try to do is maximize the cars as they come back north to load. And we'll continue to do that again this year. To address the labor front, we are not experiencing any crew-related issues at this time. But if you look back, July of 2019 was our peak number for crews. And this year, in July, we were operating with slightly less than our peak number. We currently have 2 classes in session. I think the one may be coming out now. The second one will come out in September. And when those 2 classes come out, we'll actually be operating with more crews than we did in July of 2019, which was our record number at that time. So, it's really just kind of a continual process here to, evaluate the crews, evaluate the fleet, evaluate the locomotives. So if you look at what we did last year, we actually brought in a set of cars that from another railroad that we ran, I believe, if I remember correctly, for 6 months. We had a customer who brought in a set of cars. I think they ran that for 3 months. Now those have been returned, but what we've done is we've replaced those cars and added 100 cars to our fleet. So the majority of those cars are online already, and the remainder will be here prior to harvest, and they'll be ready to go. So we've added locomotives to the fleet from last year and into this year. So we're really going into the harvest, with crews that are, more locomotives, more crews, more locomotives, and more cars. If you look at our cycle times over the last 20 grain trains, which we kind of look at it in those kind of cycles of trains that completed cycle, we're turning those cars now in 18.4 days. which is something, we've really been looking at that equates to about a 1.66 turn time. I know some of you have been on these calls and over the years, and for a long time, we consistently reported our fleet would turn at 1.2, 1.2. But like I said, we're now turning at 1.6. So again, with our overall cycles decreasing, our covered copper fleet growing, kind of like BN, we grew. So I'll call it a more aggressive car maintenance program. With the slowdown we just recently experienced, we've put a lot more cars through an inspection program, through a maintenance program, in an attempt to have them ready, reduce rejects, coming into harvest. If you look at the COVID, asked about the Delta variant, are our cases up more than where they were during the lows here of a month, 2 months back? Yes. But we're really not seeing any impact from the Delta variant right now. We do have, with everything that we've done and learned over the last year and a half, with isolating and contact tracing and all, I think we've been able to stay on top of the Delta variant. So while the numbers have increased, we're really not, having an issue. And as far as bottlenecks go, we currently don't have any, but I'll just kind of throw this out. I've spoken about this before. So we did have a minor derailment last night south of Pittsburgh, Kansas. We're expecting to reopen tomorrow morning. So, while this is a minor derailment, it's already impacted 13 trains in our system, and that number will grow, before we open it. As I've said in the past, when something like this happens at KCS, we just don't have, a parallel line or something where we can reroute over and, kind of run around ourselves. I mean, even if, you look at what, and UP may speak about this later, but you look at what they had to do. I think BN was in this boat with the fires, and, UP lost a bridge and they were rerouting traffic, well out of route. So, but, they had the option. It was something to do where, like, even if we had to reroute, 300 miles or something out of route, it's still a better option than, right now we just shut down. So, those things will happen. We expect this to be open up. We expect it to be a minor deal, but, I've brought this up before I get on my little soapbox. It's just always kind of hard for us to run around ourselves. We just don't have that ability, today. And so that really kind of concludes my prepared comments, but I have to go off script a little bit. I would be remiss if I didn't address the shipper panel concerns about the delays getting into Mexico. I'll admit, if they were talking about the first quarter of 2021, delay comment really would have been valid. I hate excuses, but when the polar vortex hit, it really did kill us. And at the beginning of the year, if you looked at our cross-border cycles, we were running around 25 to 28 days. So, we were not running good till we were able to dig out of that. But you look at where we're at now, as I mentioned in our comments, we're running at 18.4 days, average cycle for our cross-border fleet. And, we haven't been running that well, in a long time. And, even if you look at the number of trains, when 2019, if you look at average number of trains crossing the border over the bridge, right now we're operating little over one train. I think it's 1.3 trains less over the bridge every day than we did in 2019. So, we're really moving way better with pretty much the same amount of volume as we had in 2019, although it is down from 2019. So I apologize for going off script there. I just, kind of wanted to clear our good name, because, our teams worked really hard to get from where we were in February and March to where we are today. And, you know, like I said before, I mean, we're really looking to grow the business going forward. So I don't think you're going to see the issues that you saw in February, you know, affecting the cross-border business. So I had to bring that up. That will now conclude my comments unless anyone has questions.
Thank you, Mike. I'll give people a second to type in their questions.
Nope, time up.
I thought you might say that. Yeah, I guess time is up. Thank you very much, Mike.
All right, thanks.
Okay, and next we will go to Norfolk Southern with Steve Ewers and Ryan Leonard.
Good afternoon. I'm Steve Ewers, Group Vice President of Customer Operations with Norfolk Southern. While we keep a close eye on the impacts of COVID on our network and address spot shortages of manpower, NS is ready for harvest. Our network is fluid and showing signs of incremental improvement as evidenced in our public metrics. Our third quarter train speed and terminal dwell are currently on pace to be the best quarterly performance year to date. More recently, our 21-day performance for these two metrics through the week ending August 20th has improved 3% and 4% respectively versus our second quarter performance. So while the velocity of the railroad is not completely where we want it to be, we are definitely seeing signs of improvement. From a resource perspective, we have 1,650 locomotives in our road fleet and approximately 150 in storage, which can be deployed as volume dictates. As we have stored older, less reliable locomotives, our mechanical team has been able to drive better reliability. Specifically, our locomotive reliability has improved 175% as measured in days between unscheduled shop events versus pre-PSR levels. This is critical to providing good, consistent service product in so much as a locomotive failure can quickly nullify all of the planning and execution by our customers and NS Transportation. On the T&E front, we have recalled T&E employees previously furloughed in addition to conducting targeted hiring. As previously mentioned, we are facing some spot labor shortages where the job market is extremely tight, but it is localized and not broad-based. To mitigate these situations, we are utilizing our rapid response go teams, as well as temporary, permanent, as well as craft transfers. We have increased our training wage, as well as implemented sign-on and retention bonuses for new employees. Lastly, we have instituted a referral program for new conductor trainees, which has netted almost 200 referrals in less than 2 weeks. So even with the headwinds in the current labor market, we're doing everything we can to attract talent, and we have created a strong T&E pipeline. Specific to grain, NS shuttle times have remained consistent over the past year. Cycle times for dedicated power sets have averaged 12.4 days year to date, and August cycle times are currently averaging 11.8. Cycle times for non-dedicated power has averaged 10.7 days year to date, with August currently averaging 10.6. So similar to train speed and terminal dwell, our recent performance is also trending better than where we have been this year. It should be noted that the average length of haul for our dedicated sets is longer than our non-dedicated sets, which is why you see faster cycle times for the non-dedicated. Overall, our dedicated power program, which has been in place since 2018, continues to pay dividends for our customers and Norfolk Southern. This program keeps locomotive power captive at the elevators and destinations that can load and unload within 24 hours, allowing us to move trains faster, resulting in a better service product. Furthermore, this creates capacity that can be leveraged during harvest. As far as expected volumes for harvest, NS expects to average 85 unit grain trains, with the low being approximately 60 in September and the high being approximately 100 in November. Of the 85 trains per month, approximately 35% of them will be export shipments. As for the grain markets, NS experienced a record soybean export season this marketing year due to the trade deal and other marketing factors. We are expecting another strong, although abbreviated, export year this year and are eager to, again, partner with our customers and participate. NS is pursuing opportunities for growth, from truck to rail conversions, to export, to new plants opening on our line, and we are allocating resources accordingly. Before I close, I wanted to touch on the question from Chairman Oberman. We have more than sufficient locomotives in storage to bring out when harvest is really starting to increase or come online. We will not have any issues bringing those locomotives out of storage. We have already implemented a weekly coordination call between our operations team, which includes the team responsible for deploying locomotives. It includes our commercial marketing team, which Ryan Leonard is joining me today, as well as customer ops. So we have these weekly meetings discussing not only what the commercial team is seeing with how the harvest is evolving and where do we see the grain flowing, the grain and beans and corn. But we have discussions with our locomotive team. We have discussions with our crew management team. So there's a lot of close communication and coordination between all the departments, and this will ensure that we are ready for harvest. At this time, myself and fellow attendee Ryan Leonard will take any questions.
Thank you very much, Steve. I will let you know if there are any questions in the chat. And it looks like that's all we have for you. Thank you very much.
Thank you.
And next we will turn it over to Union Pacific with Dan McLaughlin and Jacob Thomas.
Good afternoon. I appreciate the opportunity to spend a few minutes today to discuss the steps that Union Pacific has taken to prepare for the upcoming grain harvest. First, I'd like to provide an update as to our current network status. As many of you know, and as Mike referenced earlier, over the past several weeks, our network has been dealing with a number of service interruptions, including several extended outages in the West due to wildfires, a subsequent bridge outage, flash flooding, and other incidents. This required significant reroutes over several weeks, increased congestion in yards throughout our network, strained crew resources over reroute areas, and has required additional crews for yard and local work that has cascaded beyond just the impacted areas. As of August 2nd, the most significant outages were restored to service. However, there are and will continue to be lingering impacts from the outages over the next several weeks, including potential crew, locomotive, and car challenges at times in specific areas. It's difficult to identify a specific date when that will all be resolved, but barring any other major outages, we expect to see improved resource availability over the next several weeks, leading into harvest as our network recovers. More broadly, we continue to see supply chain disruptions and impacts, particularly with our intermodal business. Port congestion, uneven flow of goods, and delays in customers picking up containers and trailers have all contributed to rail impacts, including ramp congestion and chassis shortages, which then can lead to additional impacts. We expect these supply chain issues to persist through at least the rest of this calendar year, as it's unlikely to improve as we go into peak intermodal season. However, the supply chain impacts are not expected to materially impact the grain program, as the most significant rail impacts are associated with our intermodal ramps, which will not directly create any issues on the grain side. Now I'd like to transition to a look forward to this harvest season. Each year we meet with our large grain customers for annual harvest planning meetings. The purpose of these meetings is to understand their requirements and expectations for the upcoming harvest season, discuss current market conditions, and identify any current pain points that they may be experiencing that we can work to remedy before entering into the harvest season. Over the past 12 months, despite some of the challenges that I outlined above, Union Pacific handled more grain volume than any other 12-month period in more than 10 years. Based on feedback from the harvest planning meetings, we expect the next 12 months to be just as strong or stronger, and especially strong in the PNW region. I'd like to outline the steps that we have taken to ensure that we have appropriate resources in place to support this strong demand. Before the outages I talked about earlier, in response to demand, Union Pacific had initiated a program to bring locomotives out of long-term storage and add additional crews in specific areas and from furlough, and also hiring where needed. To address Chairman Oberman's point earlier, in order to accelerate bringing locomotives out of storage, we did add additional resources to our mechanical forces. On top of that, in response to these outages, we have pulled additional locomotives out of storage temporarily and are adding additional temporarily. And as network fluidity returns, those will be placed back in storage in strategic locations throughout our network to provide rapid response options. The active locomotive fleet that we have supports our forecast for a strong grain harvest season and also the other business that Union Pacific handles. We continue to add crews from furloughs and through hiring, and in a few areas, we will support anticipated demand with crew borrow-outs. Through these actions, we expect to have a crew base to support a robust harvest season. And finally, we have added more than 1,000 cars to our grain fleet over the past year to support this strong demand. To summarize, I'd first like to acknowledge that we are working to restore higher fluidity and speed to our rail network following major disruptions and outages earlier this year. We expect network improvement over the next several weeks as we progress towards harvest. Second, we have resources in place for harvest. We have added locomotives, crews, and cars, which will support a strong harvest demand that we anticipate. And third, our active communication with customers helps to ensure that we have a successful harvest, both through pre-harvest meetings to help us know what to expect and ongoing communication to address real-time issues and opportunities. I'd just like to close by saying that agricultural products is a very important part of Union Pacific's business mix. We continue to invest money, assets, and other resources to support this business, and we appreciate the opportunity to provide rail service to this market. Thank you.
Thank you very much, Jacob. Looks like we have a question from Marty Oberman. Go ahead, Marty.
Here I am. Just to follow up, Jacob, I wasn't clear. You said you were hiring more people to get these locomotives out of storage, but are you confident you're going to have enough? That's my question.
Yeah, before the outages that I mentioned, we saw the strong demand, and so we had an active program to pull locomotives out of storage. Unfortunately, with some of the issues that we've experienced that consumed those locomotives, and we demand even more to help recover from that. And so we've been pulling even more than we initially anticipated out of storage to support that. And my point earlier was to accelerate that. We had added some additional individuals on the mechanical side to do that. We anticipate having sufficient locomotives to support the grain customers and other customers, particularly as we see network improvement over the next several weeks in response to the incidents that we've had earlier.
Jacob, we've also got a question from Mark Houston. Mark asks, do you anticipate using embargoes to manage flows into the PNW if you experience execution failures?
Our expectation at this time, we feel that we have as I mentioned earlier, we do anticipate very strong demand going into the PNW. In response to that, as part of our planning process, we feel we have resources in place, crew, locomotive, and also through communication planning with customers to plan for that. So our expectation is that we'll be able to handle the demand, and our plan is certainly not to be in a position where we'll have to embargo any traffic going into the PNW.
All right, thank you, Jacob. I think those are all the questions we have for you. And next we will turn it over to the Class 2 and Class 3 railroad reports, beginning with Deb Alexander from Genesee and Wyoming.
Good afternoon. Genesee and Wyoming short line railroads are prepared for harvest. We have 4,130 grain cars assigned to 6 of our largest short lines serving grain customers, most notably the Rapid City Pierre and Eastern and Kyle Railroad in Kansas. Nearly all our grain cars are running in single car first mile service. In addition to our short line supply of cars, we utilize unit trains and shuttle trains, mostly from our Class 1s with Class 1 power. We have 147 locomotives that are active and ready for harvest, with 2 currently in light battered or status that'll be repaired in the next 30 days. We are not anticipating a need for additional power rail cars at this time, but will adapt if required. Thanks to many efforts, we've had no material reductions or furloughs made to our workforce in these short lines this past summer or spring. We continue to work safely through the COVID pandemic while continuing to serve our customers. In addition, we're hiring and training 17 additional employees across these 6 short lines. Besides the occasional bunching of cars at interchange or occasional delays on unit trains, there's no material concerns regarding Class 1 service nor PSR at this time. We are PTC compliant where required. And in 2021, we are spending $51,700,000 in capital expenditures on track infrastructure. We look forward to continuing to operate safely and serving our customers. Thank you. Any questions?
Thank you very much, Deb.
Thank you.
Give folks just a second. And it looks like there are no questions. Thank you very much. Next, we will go to Carrie Evans from Iowa Interstate Railroad. Go ahead, Carrie.
Hello, I'm the Vice President and Chief Commercial Officer for Iowa Interstate Railroad. For those that don't know, we're a Class 2 regional railroad that operates from Council Bluffs, Iowa to Chicago with the branch line from Bureau down to Peoria. I won't go over all the metrics that Mike distributed, but we are ready for harvest. We have plenty of power, plenty of equipment. We have experienced a shortage of crews this year, but we have 18 students right now, and they'll be ready to go at the end of September. Fortunately, we haven't been significantly impacted by the COVID-19 variant. Iowa Interstate connects with all the Class 1 carriers, so we've definitely worked through a lot of PSR changes with most of them. We have great managers in the field that communicate with their counterparts at the Class 1, so they work together to make sure the interchanges are fluid. Looking forward to a new grain year. Obviously, last year the derecho affected our grain territory, so we're still feeling the effects of that. We're just ready for our covered hoppers to be moving more consistently next year. So we're always pursuing opportunities for growth, and that's all I had.
Thank you, Carrie. Does anyone have any questions for Carrie? All right, you are all set. Thank you. And next we will go to Dan Sabin from Iowa Northern Railway.
Thanks. Where Carrie described the loss of production on their line because of the storm in August of 2020, Iowa Northern missed most of the damage, and as a consequence, we've handled 80% more grain this year or this season than we had in the prior year. For the first time in our history on Iowa Northern, our elevators literally ran out of corn during the month of August, and we are going from typically 1,500 cars of corn per month to 24 in September that are on order. We have 360 covered hoppers in service. We do a 24-hour velocity to the processors at Cedar Rapids, and we do about 5 to 5.5 turns per month per covered hopper in the fleet. We've had a number of issues with the PTC side. We're fortunate to have 3 Class 1 connections with Union Pacific, Canadian Pacific, and Canadian National. Most of the operations have gone back to a 3-day-a-week interchange, particularly with UP and CP, and that does give us some problems. CP has also reduced the amount of capacity, track capacity for the interchange, and the cars are bunching, and we're losing a lot of time with our traffic with CP. They are, however, working with us with frequent conference calls and efforts, but they're pretty strict on their cost side to ensure that that our traffic doesn't interfere with their budget. Right now, we're spending 15% of our revenues on capital spending. We installed 9.2 miles, are installing right now, of new 115-pound continuous welded rail. And we'll be completed with our entire main line with new rail by the end of next year. The other issue that we've had is we have an extreme shortage of train crews right now. We have an exceptional training program and training facility in our Waterloo headquarters, and we're finding that particularly one of the Class 1 railroads waits until we get qualified employees, and then they poach the qualified people and hire them away from us. We've had to increase wages to train crews substantially, and we have ongoing training programs, but we're not able right now to keep up. So we have temporary employees, we have a full training program in place, and we're looking at what we've got to do a better job in retaining and recruiting new train crew employees. But it is a very serious situation for us. Any questions?
Hey, Daniel, this is Robert Primus. I greatly appreciate your honesty and your comments. And I just a question. So, going forward with the season in front of you, I mean, how prepared are you to with all the issues that you raised, to sort of address the issue, the harvest, what sort of issues or help from our perspective can we lend?
Well, I appreciate that. It is rather desperate right now, and certainly even our customers are struggling to keep their workforce up. But this is the first time in my 30 years here that we've failed in service, both through the interchange issues and the tightness of our crews. We have 90-day contracts with temporary employees, so we should be able to get through the end of this year. And we've got a number of trainees in place. And we've been trying to recruit qualified and certified conductors and engineers throughout the country through social media. We're also facing with a lot of new industry on our line, and we expect to double the volume of our traffic over the next 18 months. So it is a strong concern. We have a lot of respect and a lot of appreciation coming from our Class 1 connections, but I'd say that at least in this part of the world, we're in for some problems for the next 6 months or more.
Thank you for that.
All right, Dan, I think, oh, we have a question from Board Member Ann Begeman. Go ahead, Ann.
Hey, Dan, I also want to echo really what Robert said, his appreciation for your very, I guess, your compelling statement to us. Thank you. And while we can't necessarily do anything to help you with your crew shortages, although I may be available, to thank you for just being your, I guess, your very honest statement to us. And Jared, before you move over to your new responsibilities, I hope that you will make sure the folks at CP know that we really appreciate a good resolution for the situation that's going on with Iowa Northern. Not picking a side, it takes two sides and smart people to figure out solutions, but please feel the board's pressure that we really hope that you will be helpful. And if there's anything the board could do, I know that all our members would like to be helpful if we could.
Thank you.
Yeah, and it's Jared, and yeah, definitely. I know our operations folks have been working with Dan's team on the change, and we'll continue and
thanks, Dan.
do that. And I'll relay that message as well.
All right, thank you very much, Dan. Next, we will go to Jim Lewis with Montana Rail Link.
Yes, thank you, Michael. Good afternoon and greetings from beautiful Missoula, Montana. Happy to be here today. Montana Rail Link is a Class 2 regional railroad that operates over 900 miles of track in Montana and Idaho, including 655 miles of mainline track from Jones Junction, Montana to Sandpoint, Idaho. In 2020, MRL shipped 435,000 total carloads and averaged 23.1 trains per day across our network. 122,000 of those carloads, or 27.8% of our total volume, was grain, up from 111,000 carloads in 2018. Of the 2020 total volume, 6,000 carloads were originating traffic from Montana-based grain shippers on our network. MRL services 24 local grain shippers located in eastern and south central Montana. The vast majority of the grain shipped across our line is corn and soybeans that originate in the Midwest. MRL currently operates 71 locomotives. We own 417 rail cars, of which 106 are grain cars. We utilize the BNSF grain fleet to backfill our equipment for our online shipments. And then the corn and soybeans that moves out of the Midwest moves across our line on BNSF unit train. We currently have over 100 transportation employees that are furloughed. That's primarily due to decreased trains per day that we've experienced this year. We did have a plan to bring 40 of those employees back, but due to an operational change with the BNSF, where it appears more volume is going to be moving across their Highline route in Montana, we are reevaluating that plan at this point. Our MRL's 2021 capital plan totals $44 million and includes the replacement of 141,000 ties, 11.7 miles of curved rail, 11 miles of tangent rail, and 265 miles of ballast servicing. MRL stands ready to provide safe and reliable service to our Montana and regional grain shippers. Now, I mentioned that our trains per day are down. Montana Rail Link feels very confident in our ability to move up to 30 trains per day across our line. Our forecast in the fourth quarter is 18 trains per day. So we definitely have capacity. And if called upon, that capacity will be available for our Class 1 partners and for the grain shippers in the Midwest. Thank you.
Thank you, Jim. Does anyone have any questions for Jim? Okay, it looks like we're all set. Thanks, Jim.
Thank you.
And next we will go to Michael Haig with Rio Grande Pacific.
Yes, good afternoon, everybody. Rio Grande Pacific is comprised of 4 short-line railroads. I'll be talking mostly about the Nebraska Central Railroad Company in my proceedings here today. I should note that we're also at the New Orleans and Gulf Coast Railway that we operate. Our grain handle down there in this year in 2021 was twice that of the previous years. So we did enjoy a great export program in 2021. You have my metrics. One comment I'd like to make also is about our CapEx, and in that CapEx that assumed us doing some rail relaying. We had a problem from a supply line getting our rail to be relayed, not because of COVID or anything, but because of a fire or a explosion and consequential fire at the Everaz plant, a steel plant in Pueblo, Colorado. So that set us back a bit, but it should not have any appreciable effect on what we do this fall. As far as labor issues, we don't really have, it's always tight, but we manage it quite well. We always have a natural turn in our TE&Y personnel. So we're ever vigilant all year long about how to maintain ample crews. The local unemployment area in northeast central Nebraska is under 3%, probably closer to 2%. And we expect those issues to keep on going like that. So I don't see any appreciable change of that. Again, we've got to be extra vigilant in maintaining the ample crews. We're still moderately busy with the 20 to 21 crop movement. So we should be able to blend in pretty well into the 2021 harvest quite naturally. As far as the Delta variant, it really hasn't hit us yet. But regarding COVID, early on in the COVID process or the COVID pandemic, we did leverage our regular safety program that worked very well in this regard. As we leveraged that, and additionally, we even brought on we even put on retainer a PhD in counseling to help us handle those situations. Impacts of Class 1 service. We try to work as well as possible with the Class 1s to help them coordinate their logistical flows. At times, that means we will hold on to trains maybe a day or two longer than we would like to, but we help them. We do help them with their logistics. As far as PSR, we really haven't seen a big effect of PSR there. It really, we've been we've been playing as well as we can with it. But again, in the grain side, it really hasn't translated into very much, if at all. So I guess in closing, we're as ready as ever for the 2021 harvest. Again, labor will be key. We did not furlough anybody in 2020 and 21, I should say. And we're glad we didn't, because we need those people badly, and we wanted to retain them. So that really worked out well. So I'll take any questions if anyone has any.
Hey, Michael, this is Robert Primus. So you talked about how you had to hold on to cars for a couple days longer than you've had. You think you have to. Can you talk about, and I'll open this up to other railroads as well if they want to comment on the challenges of working with the class ones with relationship to switching, and sort of that maybe that first mile, last mile aspect, how that's been, and if it's gotten better or worse, or what the challenges would be, moving forward into this harvest season.
Well, thank you for that question. And this isn't the first time or the first year that we play kind of a funnel game or a Garner bin game with the UP on their main line. So it was nothing new to us to do this. We work together quite well in that respect. And we expect to do it again this year, probably. And like I said, it's maybe a day or two, but we plan accordingly and look ahead. And again, communication is always the key with the class one.
So basically, you see this as the cost of doing business.
I wouldn't say it's a cost, sir, but it's the way we plan things. If we do park loaded trains, or mostly loaded trains at interchange, they're just there for an extra time that they probably don't need to be there. Our plan is to run them up to origin and back to interchange, including customer time, in less than 24 hours. And we complete that a vast majority of the time.
Okay.
And I should also add, that's usually during the harvest rush season. Once we get out of those months, it's usually pretty smooth sailing.
Understood. Thank you.
You bet.
Thank you very much, Michael. Looks like there are no more questions for you. And so next we'll move to Dave Long from Twin Cities and Western Railroad.
All right, good afternoon. I'll start off with grain trains. Virtually all the grain trains we handle are provided to us by the class ones in terms of rail cars and locomotives. And we've got a very good track record. Our folks really focus on turning the equipment, the trains, as fast as we can. As Mike just said, communication is a key. We communicate when the trains are coming to us empty. We try to have a crew there when it gets to the interchange point. And we're communicating at the same time with our customers at the loading elevator, so they have a crew ready and can load the trains upon arrival. And then we keep tabs with them to make sure that when they're approaching full loading of the train, we get the trains crewed up and moving back to interchange. For non-shuttle, single car type grain business, we have our own fleet of several hundred cars. And we've maintained approximately the same fleet for the last several years. And it's been adequate to meet our customers' needs. We expect that to be the case for the upcoming harvest. We are PTC equipped, and we're in good shape from a labor standpoint. We've got crews that have worked really hard this year, especially the first half of the year, and we're in good shape coming up for harvest. Same thing with locomotives. We've maintained a similar fleet the last few years, and it is PTC equipped. And we don't expect any changes. We expect the crews and locomotives, like I said, to be capable of handling our harvest expectations this fall. We've been fortunate and have not been impacted by the Delta variant, and we hope that continues. We remain vigilant. And
As far as impacts of any changes to Class 1 service or the impact of PSR, again, it really goes back to communication. Our folks are very proactive, and usually if we have trains coming at us, we've got good communication days in advance, and then we update those ETAs as they get to us. Interchanges will generally remain fluid, and really, as Mike said, again, it just gets down to communication and to help either avoid any issues that might arise or to minimize anything that might arise so that we can work together as partners to make sure we're taking care of our customers and moving as much grain as possible. So with that, we're ready for harvest, and that concludes my short remarks.
Thank you very much, Dave. We'll hold for questions for just a moment. Okay, looks like there are no questions. Thank you, Dave. And next, we will turn to Jimmy Patterson from Watco Companies.
Hey, good afternoon, everybody. Thank you very much for letting me participate today. Watco currently operates 42 short line railroads here in the United States. I'm mainly going to focus on our 11 railroads that we consider to be grain centric on today's call. Agriculture and food products continue to be the leading commodity for Watco. Happy to say that through July year to date, we have our carload numbers in that agriculture division are up over 2020 and 2019. So we've seen some good success from our shippers. As far as equipment goes, Watco has 503 total locomotives in service today. 129 of those are operating on those 11 railroads I mentioned before. And we have an additional 15 locomotives in a surge fleet ready to be deployed as needed. We've got just under 1,800 owned grain cars in service with an additional 540 leased cars. So we've got somewhere around 2,200 cars in our grain fleet right now. All those, of course, for manifest online moves as we continue to rely on the Class 1s for locomotives and unit train equipment for any cars going offline. Turn times based on the agreement with our Class 1 partners, 24 to 48 hours, getting those unit trains off and back into interchange. As far as PSR goes, no real concerns from our side. We haven't seen a huge impact on PSR. Continue, as mentioned before, communication with them on these interchanges, and any minor issue that does come up is quickly resolved and we move on servicing customers together. No team members furloughed right now, and we are actively hiring as we continue to add and acquire additional properties. COVID has been spot hit here and there. Nothing that stopped trains from moving or kept us from getting locomotives repaired. We were able to function and continue to function through any COVID outbreaks that occur on our properties. Safety obviously continues to be a big focus for us. We were the recipients of 29 JAKE awards. 26 of those were JAKE with distinction, and we received 2 President's Award for Safety from the American Short Line Association. All locomotives required to have PTC are equipped and operational. Our capital projects for the year, we're going to spend somewhere between 45 and 50 million on capital. In addition to the routine maintenance capital, we have a big focus on expanding some of our railroads up to 286 capable lines and getting some of them from 10 mile an hour to 25 mile an hour. And we're adding numerous sidings across the network to assist in meeting and passing these trains and getting them off quicker. Additionally, I would like to add the state of Kansas, where 3 of our railroads are located, is in the second year of what they call the Ike funding, named after President Eisenhower. And the state of Kansas and KDOT has set aside $5 million to make available to any short line in the state of Kansas, and more importantly, to any short line customer in the state of Kansas. They announced those recipients last week. And so what this allows is for short line customers to expand their facilities. So if we've got a small cooperative that's a 10-car spot, they get the funding they need to expand to a 20-car spot. or 15 to 30, et cetera, et cetera. So it's a great program. We've backed and supported since day one and helped our customers to fill out these applications. It is a 70-30 match, so there is some skin in the game for the customer, but the state does pick up a large chunk of that. And it's been a successful program that we generally support and get behind 100%. We're posed and ready for fall crop here right around the corner. We're hearing it's going to be a banner year for us here, starting in the next month or two, and we're posed and ready for anything that's thrown at us. I'll take any questions that you have.
Thank you very much, Jimmy. Just waiting for a moment for questions. And it looks like we're all set. Thanks, Jimmy.
Thank you.
Okay, and so next we will be going to closing remarks from the Surface Transportation Board members, beginning with Vice Chairman Robert Primus. Robert, go ahead.
Thanks, Mike. First of all, I want to thank everyone, every panelist, every participant for their input and participation today. I thought it was an outstanding meeting. I, for one, learned quite a bit and appreciated everyone's time to sit down and present. The questions as well were great. I really want to also thank the executive committee. I want to thank Jared. I know he's moving on now, but I appreciate his leadership since I've been on. I'm amazed that it took me such a short time to chase him out of his position, but with Shane coming in, I know that the council's in great hands, and also with Mark staying on board, we've got a very solid foundation. I'm very comfortable, with the council moving forward. I particularly want to thank Mike Small. This was no small task in getting this back on virtually this year and coordinating all of the individuals, panelists, and just coordinating everything from behind the scenes, getting all the computer networks and operations up and running today. And Mike, you'll make it look easy, and I know it's not. And I just want to thank you for all of your efforts, for all of the work behind the scenes. Tremendous job on your behalf. The success of this in no part is due to all of that hard work. And so, I want to say thank you. I know you're moving on as well. It's the council's loss to see you go. You've done a great job, and I thank you for supporting me and helping me along the way. So I just want to say again, kudos to the entire executive board. Thank you for allowing me to be part of your team over the past several months, and congratulations on a job well done. And so with that in mind, I will turn it over to the chairman of the board, not Frank Sinatra, but Marty Oberman.
Thank you, Robert. And I've been confused for a lot of people, but never Frank Sinatra. Robert really said it all. He spoke for what I would have said to the entire Grain Car Council and all the presenters today. I do want to add my applause to Mike Small, not only for the work he did to pull this meeting off, but last year and previous years, he's really held up more than his share of the workload to keep the Grain Car Council functioning so well. And he is moving on, but he is not leaving the board. He is a very valuable asset for us, and I'm glad we will hold on to him. And I want to welcome Alan Cassidy, who the board has selected to take over as the designated federal officer for the Grain Car Council. I think you'll all grow to love Alan, and he actually has somewhat of a personal farm history, and I think he'll be very well suited to carrying on Mike's fine work. So thank you all again. I appreciate it. And now I'm happy to turn the microphone over to my esteemed predecessor, Ann Begeman.
Thanks, Marty. Hopefully you can hear
I am sorry, you're cutting out a bit for me.
You know, it's actually as my 11th one sort of just stands out as one of really one of the best ones. So really, thank you, everyone. Thank you, Jared. Congratulations on your new role. We'll miss you here on the council, and Terry and Mark, thank you so much, and Shane. And of course, Mike Small, thank you. And Robert, way to go, your first time out. Again, thank you, everyone, and all the participants, all the panelists. It's great to see a lot of familiar names. Jerry Cope, I'll be giving you a call. And the attendees who joined us as well. Thank you so much. And it is my great pleasure to turn over to Patrick Fuchs.
Thank you so much, Ann. I want to echo what my colleague said. Thank you to all of our presenters and facilitators, the executive committee, Mike Small and Robert. You all did an excellent job. I found this meeting to be extraordinarily informative. I expect the board will continue to proactively engage with shippers, carriers, and other parties throughout the harvest. We will keep the lines of communication open, and every participant in this meeting should know that you can contact the board at any time, and we stand ready. So thank you all very much for your time and insights today, and I'm pleased to turn it over to my colleague, Michelle Schultz.
Thanks, Patrick. First, I'd like to thank all the presenters today for putting on such informative sessions. They were so incredibly helpful to me. I'd like to thank Mike Small, Chairman Jared Farmer, as well as my colleague, Vice Chairman Robert Primus, for all of your time and energy that you put into making this conference so successful. And lastly, I'd like to thank all of the members of the National Grain Car Council for the important role that all of you play in furthering the nation's economy, and wish everyone all the best with the upcoming busy harvest season. Thank you. I guess with that, I would turn it over to Chairman Jared Farmer.
Thank you. I think in closing, I'd like to just thank the members of the STB, all of which have been a pleasure to work with over the last few years. And I'd also like to thank the shipper panel and my railroad colleagues in the class 1s, 2s, and 3s for the work they've put into the report outs. I truly believe this meeting is valuable in that it brings us all together to get aligned on the conditions that affect our collective industry each year. And I think I want to thank you all for your participation, especially these last couple of years where we've had to do this virtually. I think it's still been valuable, and that's why we decided, back in 2020 to do this virtually, because we all felt between the board and the shippers and the railroads that this was valuable, and we still needed to get together. And I would echo Marty's comments, well, everyone's comments, that Mike Small was key in delivering this and took on an immense amount of work to get it done. So really appreciate that. And so I think that's it. I think we're ready to adjourn. Thanks again for a great National Grain Car Council. Look forward to seeing some of you at Tegma tomorrow, and hopefully we'll see some of you later this evening as well. Thanks, everyone.